Good morning, everybody, and thank you so much for being here this morning, this beautiful venue, the Aria Wine Estate. It feels really good to be here. The lights up here is very blinding, so I'm trying to see everybody, but it was very nice to greet all of you, or a lot of you this morning. It beats the hell out of Zoom webinars. It's very informative, but this is far nicer and really great to see you all. From Robert Walton, the BCI team, Olga, Tanya, Jade also here. Thank you so much for being here and your continued contribution in making BCI a huge success over the past 11 years. Before we get going, just very quickly, the QR code on the screen behind me now. You know the story by now. You need to scan in and don't forget to scan in out again this afternoon when you leave. The agenda behind me, we made again, or the team again made sure to have a well-packed agenda where we're going to cover mostly all asset classes. We're going to look at SA equity. We're going to touch on global equity. We're going to look at SA fixed income bonds specifically, especially after the rate cut of the Fed. We don't know where Europe is going yet, but I think a lot of that conversation is going to come out today, and what that means for growth assets globally, and what it means for fixed income assets, not only in SA, but we're also going to touch on some of the global fixed income assets. A lot of questions from clients. I mean, there's still a lot of turmoil out there or geopolitical risks, so everything isn't entirely green. And we've had significant returns for the past 12 months. I mean, if you look at all asset classes, locally and globally, over 12 months, and if you take a spreadsheet and color code it, everything is green. All right, and it almost makes you feel uncomfortable because the stuff, it makes you feel it's almost too good to be true. Right. So do we need to take profits now for some of these growth assets? Do we need to look at other areas to look for growth opportunities? So what do we do? And these are a lot of the stuff that we're going to cover today. The only thing that's not green is India, but we'll see where that goes as well. Busy week in terms of announcements. We had the Fed announcement. There's a couple of other banks also still need to announce towards the end of the week. But like I mentioned, I mean, geopolitical risks is still a headwind for some regions or some asset classes. With that said, I think I'm going to get our first presenter up on stage, Simon Raubenheimer from Contrarius, all the way from Jersey. Simon, thank you so much for joining us this morning. Really good to have you. And interesting, I mean, a lot of you know Simon from a lot of our webinars and previous conferences. He always presented on the Contrarius Global Equity Funds with a phenomenal track record. But they recently launched SA products. Very interesting. And I normally say, you know, if you look at SA fund managers, they tend to launch global funds. A lot of global fund managers launch feeder funds in SA. It's very seldom that you find a global manager with a good track record launching products in SA. And it's very interesting to hear what you have to say as to why you've done that. Simon, thank you so much for being here.
Thank you very much, Eugene. It's amazing being back in South Africa. It's actually incredible being back in my sort of favorite part of the world. It's great seeing a lot of clients and actually a lot of friends in the audience. So really good to be here, and thank you to BCI for the opportunity to present you. As Eugene said, most of you have heard us talk about our global funds. What a lot of you don't know is that we recently launched a few South African funds, and maybe over the course of the next few slides, I can talk to you about the rationale and why we invested. So we'll look to answer a few questions. The first question is, why South Africa? And this is just very high level, couple of slides, top down. You can see that confidence in South Africa, and this is no surprise to all of you, from both consumers and businesses. You can see in red, consumer confidence there in blue. The bits below the zero would indicate pessimism. So no confidence, and when businesses or consumers don't feel confident about the future or not optimistic about the future, they don't borrow, they don't spend, they don't invest, economic activity slows, and we've seen all those things actually take place in South Africa. And as you can see there, that's been the case for a number of years. In addition to that, foreigners are pretty pessimistic. So these are foreign flows into South African equities. And the red bar charts are annual numbers going back to 2017. And the blue line there is the cumulative numbers. So just all the red numbers added up. And you can see since 2017 up to now, almost $1 trillion has been disinvested from South African equities by foreign investors. In other words, they've sold net $1 trillion worth of South African shares. And you can see there, even the GNU last year made no difference. The annualized flows this year actually run at more or less the same rates as the annualized outflows over the last few years. And that pessimism has resulted in a market which has underperformed the MSCI World Index for quite a number of years now. So this looks at the FTSE JSE All Share Index versus the MSCI World Index, both in US dollars. And you can see there a nice build-up to sort of the 2010 World Cup. And from then, we've had a massive underperformance. So we've gone from a level of almost 4 to a level of below 1.5. So that's like a 65% underperformance by South African shares. It has started ticking up, but you can see on a longer-term chart, it's still sort of a drop in the ocean. As contrarian investors, we are instinctively drawn to markets, to sectors that are unloved or that are misunderstood or that are under-owned, and this ticks pretty much all those boxes. And we're starting to see valuations now that are sufficient, and in fact more than sufficient, to compensate us for the risks in South Africa. So we don't like South African shares because we think the economy is about to boom, or because of all these green shoots that one may or may not see. But we think even if things don't improve massively and just carry on the way they have been, valuations now we feel are sufficiently low to generate reasonable returns even in a slow growth environment. And I'll take you over the course of the next few slides, I'll take you through some examples. But first we want to answer a second question, and that is, are we actually able to be different to everyone else? We're of course contrarian investors, so we don't want to look like anyone else, or at least don't want to look like everyone else. So are we able to be suitably different? In order to generate alpha, we feel you have to look different to the benchmark, to outperform the benchmark. And what this table here shows is this is our top 10 shares. So from 1 to 10, so Naspers is our biggest share, Prosus is our 8th biggest share, but given that the underlying drivers are very similar, I've just lumped them together. And what we've done on this slide here is we've looked at the top 10 asset managers in South Africa, so the 10 largest asset managers in South Africa. We then took their domestic assets, and this is according to the most recent data that we got from the Alexander Forbes survey. We took their domestic assets and we grossed those assets up. So the most recent numbers we got were from 2024. So we've grossed those numbers up by what the markets moved. So basically mark to marketed. And then we made an assumption that 50% of their domestic assets are invested into equities. So it's not an exact number, it's not precise, it's indicative only. I don't know whether the number is 40 or 60 or 45 or 55. We've just assumed 50% of their domestic assets are invested into South African equities. And then what we said is, if these managers got bullish on any of the shares that we own in our top 10 fund, and they were to buy 20% of that company in their own funds, how big would that percentage be in their funds? And you can see for companies like Naspers or Prosus, those are obviously large companies, you can buy those, not a problem. But for smaller companies like the JSE there, or Sun International, or PPC Cement, if they were to buy 20% of PPC Cement, it would make up less than 1% of their domestic equities under management. All right? Same for the JSE, 1%. Same for companies like Sun International. So these are companies with market caps of between, call it 8 and 12 billion rand. The second problem in South Africa is that our market is very illiquid. And what the last column there shows is if they were bullish on those specific shares and they were to buy up to 20% of those businesses, assuming they buy 15% of the volume-weighted average price every day, which we think is a sort of a level of aggression that is kind of sufficient to buy substantial volumes without kind of interfering with the share price, without pushing the share price up too much. This is actually the strategy that we deploy in our global funds. We tend to buy 15% of the volume weighted average price. If they did that, and they were to buy 20% of the JSE, it would take them 32 months. It would take them 53 months to buy 20% of Sun International. It would take 41 months to buy 20% of PPC Cement, if they're just buying it in the market. So if you are bullish on smaller or mid-cap South African stocks, you've got to start buying those shares like 4 years in advance. So we think we are able to be different. Are we willing to be different? Well, again, we've looked at the largest 10 managers and at what they own, and you can see that amongst the 10 largest asset managers in South Africa, 9 of them own Naspers, 9 own Prosus, 9 of them own FirstRand, 8 of them own Standard Bank, 7 own Anglo Gold, etc. So there's a tremendous amount of overlap in their portfolios. Partly because of what we saw on the previous slide. It just becomes very difficult for smaller shares to become a substantial holding in your funds. Of those 10 shares, only 2 of those are in our top 10, and they're effectively, again, Naspers and Prosus, very similar. Again, from a sectoral point of view, this is just our top 10 quickly again, and you'll see Naspers and Prosus, but the other shares are very, very different. And from a sectoral point of view, we also look very different to the benchmark. So we are able to be different, we are willing to be different, but can we actually outperform? So for that, we look to the only track record we have really, and that's of our global fund, which we launched in January of 2009. And you can see there in blue is our global fund. Had you invested $10,000 into the Contrarius Global Equity Fund, you would have made sort of 9.5 times your money. Had you invested it into the world index, you would have made around 6 times your money. And had you given it to the average manager as measured by Morningstar, you would have made around 4 times your money. So we have demonstrated, at least globally, that we can outperform. So let's run through 1 or 2 quick examples of the opportunities that maybe just before I move on, we launched 3 funds in South Africa. One is a domestic-only equity fund, one is a general equity fund, one is a general balanced fund. Both our general balanced and general equity funds feed through into our global funds. And in terms of Reg 28, we can invest up to 45% into those funds. And actually, as a retail investor in South Africa, you're getting these funds at an institutional fee class, which we think is pretty attractive. So what are some of the opportunities that we're seeing? The first looks at a basket of stock exchanges all around the world, and you can see that we've got the Intercontinental Exchange, the Chicago Mercantile Exchange, or the CME, the LSE in London, the Hong Kong Stock Exchange, Australia, etc. And we've basically grouped them all together, formed a basket of stock exchanges, and this is pretty much over the history of Contrarius. So you can see, had you invested $100 into a basket of these stock exchanges, you would have made 7.5 times your money. So stock exchanges actually globally have been a great place to sort of invest your money. These are not the indices, these are the actual operators of the stock exchanges, so the companies running the exchanges, running the platforms. This is what the JSE's done relative to those indices. Despite the fact that the JSE does, by and large, what the other exchanges do, they've underperformed by, you can see there that 2010 peak, they've underperformed by sort of 75%. And we're now looking at valuations, and this is a very busy table, you don't have to go through the detail, but we have all those exchanges on the left-hand side, so the CME, the LSE, the Hong Kong Stock Exchange, right down. We've got Australia there, the ASX, we've got the New Zealand Stock Exchange there, Dubai, Japan, etc. I mean, the first thing to notice is the market caps of these stock exchanges. So like the London Stock Exchange is a $70 billion company. And right down at the bottom is the JSE, which is a mere 650 million, so 0.65. And you can see, and here we've just pulled the Bloomberg numbers, so to be completely objective, we've just looked at the Bloomberg estimate, 1-year forward PE ratio, and you can see the average there is just below 26 times. You're buying the JSE at less than 11 times on Bloomberg consensus numbers. And even 2 years out, you're paying 10.4 times earnings for the JSE, whereas a similar basket of exchanges elsewhere in the world trades at sort of 2.5 times that valuation level. So we think valuations now in South Africa, and this is one example. I can show you countless examples of financial companies, of industrial businesses in South Africa that trade at 60, 70, or even higher discounts to similar counterparts elsewhere in the world. Jumping to a completely different sector, this is a mining and commodity space. This is African Rainbow Minerals, and the left-hand chart there shows you the sum of the parts. So African Rainbow Minerals owns 75 million shares in Harmony Gold. Those 75 million Harmony Gold shares are worth around about 100 Rand per African Rainbow Minerals share. So if I just take that Harmony stake and I deduct that from the market capitalization of African Rainbow Minerals, the company's left with 22 Rand a share of net cash, so no debt, net cash of 22 Rand a share. And then you've got a bunch of other assets that are highlighted there in light blue. Those consist of iron ore mines in the Northern Cape, world-class manganese assets, 3 platinum mines, coal assets, etc. You're roughly paying just over 65 or 60 Rand a share, 65 Rand a share plus minus for African Rainbow Minerals' other assets. If I take the net cash and I take the stake in Harmony away from the market cap, that's the implied market value for the rest of African Rainbow Minerals' assets. Now, African Rainbow Minerals, excluding Harmony, in 2019, 2020, earned between 20 and 30 Rand a share. And actually, in a good year, those assets will generate 60 Rand a share. And we're actually pretty optimistic on the trajectory of African Rainbow Minerals' rump or their other assets. So you're paying between kind of 2.5 and actually in a good year, 1 times, just over a 1 times multiple, which is incredibly low. And by the way, we also think that grey block, their stake in Harmony, is very attractive. Harmony at spot gold of 3,700 or wherever gold is now, is probably on around 6 times earnings. So the sum of the parts is just too cheap to ignore, and we don't see a lot of these types of opportunities elsewhere in the world where, remembering that sort of markets are trading at near their all-time highs. So just finally, quickly, we've got the 3 funds. We've got the South African-only equity fund, which is fully invested into domestic equities. We've got a general equity fund, which is currently 63% in South Africa, 36% in global shares, and those shares mirror our global equity fund. And then we have the general balanced fund, which is, as we speak, around 57% invested in South Africa and has a 43% exposure, again, to assets that would sort of mirror our global balanced fund. And I'll leave it at that. I've still got some time for questions, Eugene. Happy to take those.
Many thanks, Simon. There goes the sound again. Right, any questions from the audience? We don't charge, it's for free. Right. Simon, just very quickly on resources, because I mean it's very topical at the moment, and
Yeah.
you've showed some of your holdings there. And if you look at our currency trading stronger relative to the dollar, or vice versa, the dollar under pressure at the moment, good for commodity prices. Are we at a place where it really becomes overweight or underweight resources again, whether you're going to outperform or underperform?
Yeah, unfortunately, that does seem to be it's a structural issue in South Africa. You've got kind of 3 big pockets. One is SA Inc., which is exposed to economic conditions in South Africa. And then you've got 2 bits of rand hedges. One is the resources rand hedges, and one is the non-resources rand hedges, which would be your British American Tobaccos, your AB InBevs, your Richmonts, and basically whether or how well you do depends on how well you can sort of allocate the assets between those 3 large groupings. So that is a very important consideration. We happen to be bullish on resources. So we think in a world that's sort of deglobalizing and countries are building up their own supply chains again and domestic manufacturing and those things. Also with a lot of countries having underinvested, particularly the West, into their infrastructure and things. You can see infrastructure is creaking in many places around the world. We think that is a great environment for commodity prices going forward. So at this point, we're actually overweight the resources sector, both like commodities used in infrastructure and those things, basic metals, but also precious metals. So we are also pretty optimistic about the prospects of things like gold going forward in an interest rate sort of falling environment. We saw 25 basis point cut in the US yesterday. So we think that'll provide further tailwinds for gold, with people losing sort of faith in, monetary policies and the status quo of the dollar, or just, fiat currency. Plus, geopolitical uncertainty. So we think that's a good environment for precious metals. You have seen some of it, of course, is in the price already, but I wouldn't be surprised to see gold prices continue to go up, as well as all sorts of alternative asset classes, hedges, things like even Bitcoin and various other alternatives. I think we're going into an environment in which the outlook for those is pretty positive.
We recently had you on the offshore manager webinars as well.
Yeah.
But just maybe quickly to touch on your global component in Balanced and the equity fund, which is the Contrarius Global Equity Fund as we know it. Just very briefly, your views on the US. It's almost coming from how tall can trees go?
Yeah, I mean, so we like the US as a market. It's obviously, it's hard to talk about it's not one big homogenous market. You've got several things happening in the US. You've got really the market's been driven by the MAC 7, which at this point we're actually substantially underweight. And then you've got the S&P 493, or whatever you want to call them. Those shares have lagged substantially and have actually underperformed most Western, at least developed world indices, whether it's UK, Europe, Japan. The rest of the US has underperformed many of the other indices for 1 year, 3 year, 5 years. So we're seeing tremendous valuation disparities in the US, or value disparities, and massive opportunities in other companies outside the MAC 7. And in fact, even amongst some of the MAC 7, I think one has to be selective, but we're still seeing selected opportunities there. So we have probably about 74%, I think, at the moment, invested in the US, which actually is underweight the MSCI World Index, which is at 75 or 76. Our biggest area of overweight in our global funds is actually Asia, ex-Japan. So we see tremendous value now in China. It's another asset class or geography that global investors have just ignored or been too scared to touch amongst all the tariffs and geopolitical uncertainties and trade issues, and we're seeing tremendous valuations there. So that's actually our biggest overweight now in our global funds.
When you manage your funds, we've seen with some of the quality managers, not that they are a quality manager, but a lot of these guys seem to buy into shares and they keep on hanging on to shares. Your philosophy is you don't fall in love with a share. If a share works and it makes money for clients, you hold a share. But if it doesn't, when do you sell a share? When do you start to capitulate?
Yeah, look, we look at the numbers. So we have forecasts and projected rates of return going forward. We typically look 4 to 5 years out. And we have an expected rate of return for every single share that is in our share universe. We've got several hundred shares in our share universe. Those all have expected rates of returns, and we pick the most attractive rates of returns, irrespective of what the company is. So kind of on a risk-adjusted basis, we are pretty relentless. If a share runs really hard, that projected rate of return, that sort of discount to its intrinsic value narrows, we move on quite quickly. Unfortunately, very often we tend to buy early, so it takes a little bit longer for us to realize that. But we keep rotating into what we think the best ideas are from a total returns.
And I mean, you've showed it before as well in your initial slides. To run a strategy like that, you need to be nimble enough to actually be able to do that.
You have to be able to move quickly, especially nowadays where things change so fast. You have to be willing to change your mind and update sort of your models in light of all the new things coming out. Yeah.
Simon, thank you so much. It's very interesting to me to see a global fund manager actually entering into the SA space. It says a lot.
Great. Thank you, Gene.
Thank you so much.
Thank you very much. Cheers.
Fantastic. Right, we're continuing discussions on SA equity. Next presenter is Charles Gous from Batelier Capital. Charles, you can come through so long. I'm just on that side. I'm looking at the wrong side. Thank you so much for being here this morning. While Charles is coming onto the stage, if you look at SA equity, again, it gave clients over the 12 months ending August 26%. And some would say, no, but we came from a long base, and some will say, but SA equity had a tough time for the past 10 years, so we're almost playing catch up. But was some of this returns front-loaded or not? And where are we going with SA equity? And we're going to talk a lot about SA equity now. Charles, thank you very much for being here this morning. The floor is yours.
Thank you for the introduction, Eugene. We've certainly got a lot of lights here. Thank you, everyone, for your patience. You're going to have to go through 5 presentations of SA Equity, so good luck with that. As Eugene said, I'm Charles Gous from Battalion Capital. Today, I would like to tell you a little bit about our business. We'll touch on what we've seen in the markets here to date and discuss a couple of investment opportunities. So let's get into it. Battalion Capital was founded in 2004. We launched our first fund, a long-short hedge fund, in 2005. But importantly, we've got an experienced and stable team that's worked together for a long period of time, and the same portfolio managers that started the funds are still managing them. We're not a large business by AUM, so we can be nimble and flexible. We can access the broad opportunity set that's available on the JSE and drill down into that mid-cap sort of opportunity set that was discussed earlier. We've got a consistent investment process that we apply across all the funds that we manage, with a clear focus on risk management and downside protection, given our hedge fund background. And we've built up a 20-year track record, so we've been around for quite some time. And over that period, all of our funds have delivered on their objectives. So let's get into the presentation. So just to set the scene, what have we seen this year? Global equities, like we say on the screen, has continued to climb this wall of worry. So we see share prices making continued gains, notwithstanding various external threats. The dollar has been weak. Precious metal prices and precious metal equities have been strong. And if we come back home, SA GDP growth has been revised lower. We've had to deal with GNU instability. Foreigners continue to sell our shares, but importantly, local fund managers are also underweight domestic equities. And in our opinion, the Reserve Bank continues to be very conservative in respect of monetary policy. So with that in mind, the JSE, when we did this exercise, is up 24% year to date. 27% as we stand here today. So if you look at the chart on the screen, what we've done, the dotted line is the performance of the JSE. The equities to the left are those that's outperformed the market. To the right are those that underperformed. And it's very clear that we've had an extremely narrow market year to date, with all of those equities to the left pretty much being precious metal miners, so gold and PGMs, a select few telecom companies, and a couple of the deal-listed names. And the long tail to the right actually reflect what has been happening to SA-facing equities, with a number of companies that's underperformed the JSE year to date. If we double-click on that information, I'm just going to stick to the numbers as it was at the end of August, but the trends are the same. Excluding precious metal miners, the JSE is up 11.7%. Excluding telecoms, it's up 9%. And if you take out the dual-listed companies, the JSE is only up 1% relative to the 24% to the end of August. So again, very narrow market. Essentially 70% of returns year to date has been from 5 companies, being Naspers Process, Anglo Gold, Goldfields, British American Tobacco, and MTN. You saw the chart earlier of the long-term selling from foreigners of SA equities. This one is just year-to-date data, and you can see some of the prominent SA-facing names like Shoprite, Absa, Tiger Brands, Bidcorp, billions of rands of continued selling from foreigners. And that's really based on uninspiring GDP numbers that we've seen year-to-date. What's also important is we look at valuations. What we've done here, this is a basket of SA-facing companies. We can see around the election last year, valuation multiples was approximately 10 times earnings. On the optimism of reform and accelerated GDP growth, SA-facing companies re-rated to approximately 13.8 times earnings. And this year has given back all of those gains and are again trading down to 10 times earnings. What is important is, obviously in this environment, given the lower valuations, we continue to find very good opportunities to deploy capital, and we'll go through a couple of examples. But also importantly, these opportunities are not based on we seeing an acceleration in domestic GDP growth. Much more self-help and low levels of compounding that will deliver shareholder returns. So let's get into a couple of examples. First one is Remgro. Remgro currently trades at a 43% discount to its net asset value. It's pretty much the highest it's been since 2002. So simplistically, for you as an investor, if you buy Remgro shares, for every 57 Rand you spend buying Remgro shares, you get 100 Rands worth of net asset value. That's a great deal in any scenario, but you need to understand why that discount has increased as much as it has. And on this chart, sort of to the middle and the left, you can see what's happened at Remgro. Earnings growth has stalled over the last couple of years. With that, dividend flows back to Remgro has reduced, but the good news is that's all about to change in the period ahead as earnings inflect higher. So there's three key drivers of this. Firstly, they've completed their transaction with Maziv and Vodacom. That results in a reset capital structure for the Maziv business with increased dividends and earnings expected to flow to Remgro. The Heineken-Distell transaction was disastrous. That business has now been restructured and will show profitability going forward. And Mediclinic Switzerland is also restructured and expected to show profitability going forward. In fact, Remgro came out with a trading statement just last week, and earnings for June financial year 25 is expected to be up approximately 40%. So that turnaround has started, and as dividend flows increase to Remgro, as well as higher earnings, we think that net asset value discount will narrow. The next example is also a discount trade. Call it Remgro's sister company, Reinet. Reinet currently trades at a 30% discount to its net asset value. Not at the highest levels it's been over the last couple of years, but substantial given two very important transactions. In January, Reinet sold their stake in British American Tobacco, and in July they announced that they're going to selling their 49% stake in PIC. Now, why is this significant? Those two assets are 80% of the net asset value of Reinet. So by the end of the year, Reinet will be holding 80% of its net asset value in cash, yet the business is trading at a 30% discount to net asset value. So we can calculate on a pro forma basis that Reinet will have 5.4 billion euros of net cash by the end of the year, another 1.4 billion in private equity and fund investments, so highly liquid and a lot of faith in that valuation. Yet you can buy Reinet at a 13% discount to its implied cash and a 30% discount to its net asset value. We don't think Reinet will continue to exist in its current form. There's various scenarios. The structure can be collapsed. There's a potential scenario where Reinet can do a transaction with Remgro. Be it as it may, there's a great opportunity here to unlock shareholder value. The third example I'll discuss is Standard Bank. It's really a very simple story. It's a story of a quality compounder at a very low valuation multiple. Standard Bank has grown its earnings at 10% a year for the last decade, 9% per year more recently. We expect it to continue to grow 10% in the period ahead. It's done exceptionally well in expanding its African franchise, and that's what's driving the growth. It's a high ROE business of approximately 20 times or 20%, and you can buy it at a low valuation multiple. So simplistically, when you buy, for instance, a low valuation multiple like Standard Bank at 8 times earnings, and it grows earnings by 10% per year, and it pays you a 7% dividend yield, you should create shareholder value of 17% per year. At 15%, you double your money every 5 years. So we think this is a very attractive proposition with low levels of downside risk and a high carry on the dividend yield. The last example I'll touch on is Bidvest. To understand this opportunity, you need to tear Bidvest apart. Within Bidvest is a high-quality services business, both domestic and international, and they've been driving the international expansion. Why do we hammer on services? Services is a very capital-light business model that creates a lot of free cash flow. So if we look at the peer group of these companies listed internationally, they trade at very high valuation multiples. Bidvest is also a consistent grower of earnings, grown earnings at approximately 10 times per year for the last couple of years. So we expect a similar trend to continue going forward. Yet, Bidvest is valued as if it's a South African-only business at 10 times earnings going forward. We think there's a similar play that can happen with Bidvest Services relative to what they did with Bidcorp, where they separately list the business to unlock shareholder value in the medium term. This has been the story of the year for South African equities. GDP growth has been revised lower. We started the year expecting an acceleration of growth to 1.7% for 2025. At this stage, we're hoping we'll get to the 1%. I also won't hammer on this chart. I think you've seen it plenty of times. South African valuations remain attractive, both on an absolute and relative basis. And I showed you the chart earlier, especially of the SA Inc. portion, how lowly that is valued. This is an area that's been disappointing year to date, South African interest rates. As I mentioned in my opening remarks, we think the Reserve Bank has been overly conservative. Inflation is very much under control. We can see yesterday, again, a print coming in at 3.3%, yet our rates remain very high. This is a chart of the real rates, so it's a difference between the rate and inflation. It's pretty much the highest it's been since 2003, and a real opportunity for the Reserve Bank to loosen the reins and the pressure on the South African consumer. So this is an area where we think the Reserve Bank could have been much more active in supporting economic activity. So, question we always get, what is the catalyst? What's going to unlock value for shareholders in South Africa? There is no clear catalyst. It's quite simple. We all read the same newspapers. We know what's going on. But what I can tell you is when you've got very low valuation multiples and good businesses, something is bound to happen. And the most obvious is corporate action. I've listed a couple of companies there where there's been corporate action recently: Adcock Ingram, Kiro, Barloworld, African Rainbow Capital, MultiChoice, Sasfin, Capital and Regional, yesterday, Metrofile. And you can see what's happening to the share prices at the bottom as these companies are being bought out at significant premiums relative to their recent share prices. I think it's also important that a number of South African companies are paying very healthy dividend yields. We talk about 7, 8, 9%, some even 10%, which is sustainable. So you get paid to wait as a shareholder. You've got a very high and favorable carry over time. So if we look at the opportunities we discussed today, I think it's, we want to hammer on the point that we're not bargaining on any acceleration in GDP growth at this stage. Yet there are companies that can deliver very good shareholder returns from dividends and reasonable earnings growth. And I'll end off with a last slide, given all the pessimism around South African equities as reflected in the valuations. This is a slide of the JSE All Share Index in US dollars relative to the world index. Over the last 5 years, the JSE has outperformed. It's delivered 16% per year versus 13.6% for the MSCI World Index in dollars. If we do the same exercise over 10 years, 15 years, and 20 years, the JSE has underperformed the World Index. Yet over the last 25 years, your clients and JSE equities in dollars have done well. So the closing thought is really that when you have low valuation multiples and quality assets, you can still generate good returns. Thank you very much.
Charles, that last slide just about nails it. I find it extremely interesting because we've heard so many times in the media from some intermediaries and reporters, go global, go offshore, forget about SA, but there we have it. Just very quickly, we're going to talk a lot more about resources in some of the presentations to come. Simon also made some comments about that. But is it a no-brainer just to load up on resources and think you're going to win? Why hold other SA Inc. stocks?
Well, resources by nature is classified as cyclical businesses. And that's the short answer. And I think, especially in precious metals, we've seen a tremendous upswing in that cyclicality. There's some charts going around showing the gold price over time that indicates it's 5, 6 standard deviations above its norm. And then the flip side is platinum prices are below the norm. So I think you've got to be very selective in resources. It's not a one-size-fits-all. It's whether you want to be in iron ore, it's whether you want to be on copper, on the greenification of the world, it's whether you want to be in precious metals. So within resources, there's still quite a bit of decisions to be made.
Okay. With the rest of the SA Inc. stocks, and I mean, you did say there's no clear catalyst, but with things like corporate action, you think that can unlock a lot of value for investors over the next 24 months, 36 months?
We have seen it consistently over the last 3-4 years. It's actually a sad state of affairs because you do get an unlock once, and then it's somebody else's business that grows earnings and receive dividends. So it's not great for the JSE. So that's unfortunately a more reflection of what private capital is thinking about valuations on the listed market versus actually what we want to happen. I mean, the ideal scenario is we want more companies on the JSE, we want more choice and more opportunities to deploy capital. So it's not a great scenario to see continued delistings. It's sort of a half-baked celebration, you know, when a company gets taken out. You think you're clever that day, but you're losing access to a future earning stream. Absolutely.
You run an SA equity only fund, and I mean that also comes up very often with intermediaries and with clients. Is that, and I mean you showed the last slide, SA equity did phenomenal well, but do you sometimes feel that it limits you in terms of finding the best kind of growth opportunities for clients?
Yeah, I think in the previous discussion there was mention of the composition of the JSE. So I think that's firstly quite a hindrance. 20% of the JSE currently is precious metal miners. Another 15% is Naspers, so there's a third of it gone. So it's an extremely narrow market. But that's also a sign of the times. You know, when there's no interest in that long tail that I showed you earlier, then the scales tip in favor of those other companies. So it's something that will change in time. You know, if you get better growth here, you will see that whole composition of the JSE change again. But yeah, back to your question, it's a very limiting environment. And that's why, you know, we would consider a SA equity mandate as a building block in a greater strategy where other elements are added.
Charles, thank you very much. Just want to check, any questions for Charles? No? Charles, thank you so much for being here this morning. Always great to have you. Thank you. Continuing on SA Equity, Zandile from 361 Asset Management. Zandile, thank you so much for joining us this morning. I always say that when you present, you stand extremely tall. Thank you for being here.
Thanks, Eugene. I was going to say that's also why I stand in front of the podium. Not much of an option, unfortunately. Good morning, everyone. My name is Zandi from 361 Asset Management. So today I'll be taking you through an update or an intro to our firm, what we're seeing in markets right now, and some of the exciting themes that we think will drive returns for the rest of the year. But firstly, just an update or an intro to those who aren't familiar with who we are. 361's been around for about 20 years now. We're owner managed, and over that 20-year period, our team has been pretty stable, the same faces. And the reason why that's something that we like to highlight is because the same team that has produced our track record is the same team managing money today. So we really do own our track record. That's something that we're quite proud of. And we're a team that is style agnostic. We believe that markets go through different cycles, and as managers, we have to be quite flexible in responding to the environment, making sure our clients benefit, regardless of what regime we may be in at that time. And like most of my peers presenting today, we're still quite a small manager. Our AUM is around 60 billion rand, so we're nimble, we're flexible in the market, something that's been a huge benefit in a year like this. And lastly, we have quite a diverse product offering. So as a team, we manage hedge funds, unit trusts, multi-asset, and that means that we don't have a bias towards any specific product. We think each of these has its place in a client's portfolio. But today is all about SA equity. And so whenever people ask us, what do we think sets us apart? What makes 361 so different? We think our differentiation is our ability to consistently outperform on a risk-adjusted basis. I had to read that because those words are quite a lot. But what it really means is that graph that you see on your left there. It's the classic relationship in finance between risk and return. And so Alexander Forbes published their Manager Watch survey. This is at the end of June. And they looked at different asset managers who are benchmark cognizant. We were very humbled to receive the news that we were ranked number 1 out of those managers. So what it means to us is that we're able to make sure that our clients are adequately compensated for the risk that they take on. That's a principle that's really important to us, and I think speaks to our hedge fund beginnings. So how do we actually achieve that result? Well, we think that there are 2 main ingredients that go into it. Firstly, we are very active. So there, under key portfolio metrics, we mentioned the consistency of our alpha generation. Over a 5-year period, we've managed to outperform the benchmark in 73% of those months. So I haven't had to receive a grade in a while, but I think 73% is pretty decent. I mean, we'll take that. And then secondly, at heart, we are hedge fund managers. And normally people think that that means, you're the cowboys in the room, you're the guys who like to take on risk. But what it really means is that risk management is at the core of our culture. And so the way that we've shown that here in our example is our ability to protect capital during downturns. In 2020, the market was flat, and we still were able to achieve a return of about 12%. So protecting capital on the downside without giving up that upside. That is really the 361 way, and it shows consistently across all of our different mandates. So what we've shown here is SA Equity Flexible Fund, the PPS Managed Fund, which is managed by us. All of those funds have performed quite well, the red bars that you see, relative to their benchmarks, the blue bar, resulting in that consistent outperformance, which is the gray. Okay, I've done the marketing stuff now. You understand 361, right? So please tell my BD manager when you see her outside there. Onto markets, the stuff that I really like. Charles did a really great job of outlining what's been happening this year. And so we all know what a bull market is and what a bear market is. One of my colleagues has called this year the kangaroo market. It's been incredibly unpredictable. I think we all still have PTSD from April 2025, and the tariff announcement, the movements in precious, the movements in currency, it's been incredibly thrilling. And we're still dealing with, the wall of worry that was mentioned earlier. And this has resulted in a really concentrated market when we look at outperformance year to date. So this is a different picture of looking at it. And this slide is about a month old. But as of the beginning of August, only 10 shares had driven 94% of the Aussies year-to-date return. That is incredible. And Charles has been through this, but what you'll see is that without precious, without Naspers process, and even without telcos, our market hasn't really moved much. So how have we responded to this very interesting market dynamic? Well, first of all, we've made sure that we've been nimble. Now, you'll see one of our top stocks year to date has been Anheuser, which wasn't a company that's mentioned in those top 10 names. So it's quite strange to think of a company that's only up about 9% year to date, but still managed to be one of our top contributors. How does that actually add up? So what that first graph is showing you is Anheuser's share price during the year. Now, last year was all about SA Inc. And what happened to a lot of these Rand hedge names is they were under-owned, kind of completely disregarded because money was made in the SA Inc. stocks. And at that stage, the valuation was incredibly attractive, and we started accumulating shares. That gray bar shows you our relative overweight in Anheuser. So the higher it is, the more shares we had. We accumulated shares as the valuation was increasingly attractive, and then the share price did start running quite a bit, and the valuation didn't look so good anymore, so we made sure that we sold. The last results that came out, management disappointed the market by announcing, no buybacks, which is what you really need for a company like this. And at that stage, we had fewer shares and were in a very comfortable position to protect capital despite the share price decline. So that kind of speaks to how flexible and nimble we always are in this market. When the facts change, we definitely change our mind. And secondly, part of protecting capital is avoiding landmines. So normally when people hear about us being a benchmark cognizant manager, they immediately assume that we're hugging the benchmark, you're not trying to take many active bets. That could be further from the truth. In an SA equity fund, what you own is just as important as what you don't own, and we're not scared to own zero of something if we see no value. And that's what we did with Aspen. It's a decent company, it's got really great assets, not badly positioned. But the problem is that the market was overestimating the value of the company at that point in time, and we could see that the expectations were way too high relative to the price. We owned zero, and it helped us out in our performance. And lastly, strong stock picking. AngloGold Ashanti has been our preferred gold play this year. Naspers Prosus, of course, has done exceptionally well. We were given a gift in January when the shares sold off on regulatory concerns. We loaded the truck at that stage, and Tencent has continued to perform really well. British American Tobacco, another share there that was actually helped by changing regulation. And so we started owning that no longer for its high dividend yield, but for actual earnings growth as it recovered. Okay, now I've painted a really great story about what we did. What about what's coming up in the rest of the year? I've got about 5 minutes left and I haven't got there yet. So what we learned this year is that regardless of the volatility, the noise, the orange man in the White House, there are always opportunities in this market. And there are a couple of key themes that we really like right now. So firstly, the elephant in the room is precious. Gold and platinum have done really well, and they're now about 20% of the index. So as active managers, we can't afford to ignore them. And when it comes to gold, what you've seen is that the Chinese central bank has slowed down their buying, but despite this, we still think that there are a lot of factors that are going to drive an elevated gold price. Some are structural, some are cyclical, like interest rates. But at the end of the day, when it comes to the equities themselves, our preference remains for the higher quality play, AngloGold Ashanti. So our decisions are based on value at a specific point in time, and we think that that is still the highest quality, best name to own in the sector. Recently, you've seen a share like Harmony that maybe isn't the high quality play get punished by the market after its last results. We think that's also quite attractively priced right now. So with gold, we own a lot of AngloGold Ashanti, a little bit of Gold Fields, and we're actually picking up some Harmony too, because we think those are looking pretty cheap right now. With PGMs, it really is a supply side story. Supply is incredibly tight. We monitor a number of different metrics just to understand the dynamics in the market. And these are two that are showing you that supply is quite tight right now. So whether you look at lease rates, which is effectively the cost to borrow platinum, so the more expensive it is to borrow, that means the harder it is to actually find the physical metal. And those have skyrocketed, as you've seen on the slide. ETF holdings are coming down, another signal that you've got an exceptionally tight market. So we think that these shares still have lots of support, and we took up a lot of Valterra shares when Anglo American sold down. So we love that stock, and we also really like Northam as the quality play in the sector. Now, another theme this year that we think still has lots of legs is the rest of Africa. I know. I think a decade ago, whenever we heard about a new management team going into the continent, we just hit the sell button immediately. Because SA managers have struggled outside of our borders to really generate earnings growth. That's changing. A weak dollar has really helped in this department, but you've also seen a lot of these governments fixing their fiscal picture, paying down their debts, trying to restructure it. And in the case of Nigeria, you even have regulators actually supporting price increases and helping the private sector. MTN has been a huge beneficiary of this. Vodacom too in Egypt, the currency there is supporting their earnings. But it's not just the telcos theme. This also helps our banks. Our banks have done exceptionally well in the rest of Africa. They're competing against local players, international banks, and they're actually taking share. Now, the obvious one here when we think about Africa growth is Standard Bank, but you're also seeing ABSA rolling out the same playbook. Now, ABSA just has a new CEO who comes from Standard Bank, who understands how to get that market share in Africa, how to grow, and make sure that it translates into actual earnings growth in ZAR. And we think that makes for a very interesting idea when we're looking at opportunities on the JSE. So, when we were preparing this presentation, I was a bit concerned that everything about SA would be negative. So we wanted to also highlight some positive stories at the macro level. We know that growth isn't there. We all probably got ahead of ourselves last year after the GNU, and we've learned that reform takes time. Things don't change overnight. But luckily, we are an emerging market, which means that you don't need an Obama type or even a Mbeki type, who'll lead us into a whole new era. You just need stability. And we've been very encouraged by the progress that we've seen at Transnet. We own a lot of Grindrod that's exposed to this trend. We saw recently the company, despite having some operational challenges, was able to declare a special dividend and just got some rail access from Transnet. We think that's a multi-year story that's going to play out, and a company like Grindrod is very well positioned to take advantage of that. And SA is still cheap. We all talk about the relative valuation, and what you can see here is that our bonds have done well, currency's done well. That's where foreigners have flocked. But it's created a great opportunity, especially in our financials. I'll use another example with ABSA. You've got a share that's trading at about 6.5 times PE with an 8.5% dividend yield. Similar to what Charles said, you're being paid to wait in a lot of these names. And so if you look at our broader positioning, our focus at a time like this is really on those companies with strong balance sheets, self-help stories, their own fundamental growth opportunities that aren't reliant on a strong economy. So it's obvious by now that ABSA is one of our top overweights. I've been mentioning it quite a lot. It caters quite well to some of these themes that I've been mentioning. We also like Glencore, another great total shareholder return story there. Simon laid out the thesis around African rare minerals, Naspers Process, and of course Grindrod. With our underweights, it's not a comment on the quality of these companies. They're actually really great businesses, some of the best on the JSE, but their valuations just aren't as attractive right now. So we think in a year like this, you still get a lot of opportunities with these high-quality businesses that do have some visible catalysts like an ABSA. Thank you.
Thank you, Zandi. Questions from the audience? No. Zandi, very quickly.
Sure.
Rand hedge stocks, and we've seen 361 present a couple of times, especially Evan Walker when he presents. He used to love Rand hedge stocks, especially in your flexible opportunity. It's almost like run for the hills. When the Rand appreciates, I know it's almost like a bonus tailwind for Rand hedge stocks. But in an environment where the dollar is under pressure, how does that impact on Rand hedge stocks and more specifically in your portfolios?
Sure. So for our SA equity portfolio, we are bottom-up fundamental investors, but we do have a macro overlay. Now, this year has been a dollar story. Normally, when you talk about Rand hedge, it's because the Rand weakens against all the major currencies, right? So even a Bidcorp that has European exposure becomes more attractive, Richemont becomes more attractive. But this year was different because it was all about the dollar weakening. And so it actually, what we found quite interesting is that we made a lot more return on resources, which are a lot more impacted by that. And you saw some of the traditional Rand hedges that normally outperform in that environment not doing so well because of their fundamental challenges. Richemont is the best example. Luxury is going through a really tough time, and we wouldn't own a stock like that just because of currency. So Rand hedges we do love because of the great businesses that they are, especially something like Bidcorp, but it doesn't affect our allocation. It's more about the underlying value of the businesses. And even right now, you saw a lot of SA Inc. names on our top overweights. And that's where we think the value is.
Zandi, thank you so much, and we love your energy that you put into your funds with love as well. Thank you so much.
I'm lucky, best job in the world. Thank you.
Right, next up we've got Nick de Vos from Centaur Asset Management. Nick, welcome. Thank you so much for joining us this morning. The stage is yours.
Thanks, Eugene. Cool. Okay. Good morning, everyone. Tough act to follow, Zandi. I'll tell the BD manager, that's my wife, that you did a good job with the marketing at the start. So I'm going to do a similar presentation to what the previous presenters have done, just in terms of themes. So let's get straight into it. Just firstly, a business update on Centaur. So end of this month, the business is reaching a milestone, turning 25 years old, and really has been operating in the SA equity space for all that time. AUM is around 12 billion at the moment, so still very much a boutique manager. And of that 12 billion, around 6.5 billion is invested directly into shares listed on the JSE. In terms of the investment team, it's the largest that it's probably ever been, if you have been following Centaur for some time. So we 7 investment professionals on the team at the moment. And then just in terms of the funds, very focused. We only have 3 funds, flexible, balanced, and then more recently the SA Equity Fund. So just in terms of the SA Equity Fund, so got off to a very good start. So last year was the number 1 fund in the category, outperformed by just over 10%. And then that lightly shaded grey line from the start of the year, you'll see has caught up. And I'm going to get to why that is the case now. But since inception, done 20% kind of compounded return, which we've been very happy with. So why the grey line's caught up is similar to what the other presenters mentioned. Essentially, the market's been, precious metals have been the only game in town, and more so the gold names. So what this chart here illustrates is if you look at that shaded grey area at the bottom, that's essentially kind of SA Inc., or the broader JSE that has gone nowhere over the past year. But then you've got 11 shares that have really made up all the various returns. So I know we're saying this is very concentrated. Previous presenters have also said it's very concentrated. But if you go and look back at history, the returns are always concentrated. It's just at this time, it's been concentrated in specific kind of categories. So gold specifically and PGM specifically. Of the shares listed here, the only ones that we would really own through the cycles are 2 that I've kind of circled there in the red, Naspers and Prosus, about 15% of the SA Equity Fund at the moment. And then more recently, we've been building a stake in Valterra, and with Anglo's placing their last remaining stake in Valterra, we took the position up further, so that's around 6% in the fund at the moment. There we go. So just in terms of an economic outlook, so I've listed a couple positives here, a couple negatives here. I think the biggest positive is that we've cut by 125 basis points from the peak, the cycle thus far. We'll see if the Reserve Bank cuts later today. The probability is sitting at, I think, 50-60% at the moment. So it'd be quite interesting to see what they do. They've been very fixated on this 3% inflation target, which has frustrated us to an extent, so much so that we wrote a letter to Treasury about it, and no, we didn't get a reply. Other positives, this is the extract I've taken from Bidvest results, essentially saying Transnet, private sector rail concessions, an extremely positive occurrence for overall supply chain in South Africa. Now, there's numbers that have gone around, but if we are able to fix the railway networks, that could add 2% odd GDP growth to the country per annum, which would be very positive. I think this will, however, take at least another 2 years to rectify. If you asked me this 2 years ago, would have also said it would take another 2 years. So this is taking painstakingly slow, but at least things have stabilized and seem to starting to pick up at the moment. One green shoot is passenger vehicle sales in the country, up over 20% so far for the year. There is a bit of a low base there, and we are seeing a lot of Chinese vehicles entering the market, which are more affordable, also supporting that. And then this PGM and gold run that we've seen is improving the terms of trade in South Africa. Already seen a couple of people come out and rise upwards their GDP expectations for next year. Seen a number of about 1.8% for next year. And this will also support the tax collections. I think it's roughly around 40 odd billion rand in additional tax collections that we could expect next year, which makes up a big portion of that VAT kind of shortfall number that was going on around a while back. The negatives, I don't need to tell you about the weak municipalities, non-existent in some cases. We still think interest rates are too high. I think interest rates could be 100 basis points at least lower, already where we are at the moment. The ANC succession uncertainty, I think, is quite a key risk. So a lot of the presenters that are here today, we all at a RMB Big Five conference this week. So all the CEOs from JSE companies come to a conference, and we essentially speed date them and ask various questions. Helen Ziller was there earlier the week, giving a presentation. A bit of a spoiler alert. I think on Saturday they're going to announce that she's running for Joburg Mayor. It's between her and another contender, but I'm pretty sure she'll win it. So she could possibly become the mayor in Joburg. But one of the key risks she mentioned was, who takes over from Cyril. And at the moment there's two candidates. So it's Paul, which is not the candidate they would want to see, or Fikile. And why that's so important is that the ANC's decline is inevitable, and the DA is going to have to go into coalition with them. And it's the question is, what form of the ANC do you go into a coalition with? Down the line. And then US tariff uncertainty, I think we all quite aware of. So our base case remains, we still think, over the next couple of years, the economy can grow 1 to 2%. This year, probably closer to 1 or just below 1%. And then we think SA Inc. Specific shares can do 15 odd % returns per annum over the next couple of years. So banks, you've heard this from quite a few people. We think the banks are exceptionally cheap at the moment. This chart here is maybe a little bit of a complicated one, so I'll simplify it for you. But this just illustrates how First Rand trades relative to the government 10-year bond. So that big loopy circle at the bottom, that's where First Rand has traded at a premium to what the SA 10-year government bond has been, which makes a lot of sense. You should trade at a premium because generally you get growth out of equities. Bonds, you get the yield, but you don't get the growth. Now you've seen a divergence where First Rand's actually trading at a discount to the SA 10-year government bond. And what the market is saying is that First Rand, or banks actually in general, aren't going to grow, and that the economy is going to go into recession, which we don't agree with. We're seeing loan growth improving. Year to date, 5.5%, 6% kind of loan growth from First Rand. It's split. Commercials lending a bit more at the moment. The retail usually lags behind. We're seeing credit costs easing, and our expectation for First Rand is somewhere between 8-10% earnings growth per annum over the next couple of years. You're getting around 7-8% dividend yield. Add a re-rating to that, and it's quite easy to see north of 20% return per annum from First Rand over the next 2-3 years. Another theme that we like, and we've liked for quite some time, is the private sector education. We've got quite a bit of exposure to this in the SA Equity Fund at the moment. So this is just the private school market in South Africa. There's 750,000 learners. So that's about, or just over 5% of the private or of schooling learners in the country. Average OECD countries, that number's closer to 20%. Now, I'm not saying we'll get to the 20%. There's an affordability issue in South Africa. Probably the main obstacle why we won't see that growth, but there's roughly a 2 million odd student number, kind of a gap that we could potentially make up to some extent over the next couple of years. And we know why the private schools are taking share from the public. So you've got deteriorating public sector schools, former Model C schools deteriorating, and you get a superior academic outcome in the private sector. The same at the university or the tertiary level. So no new public university has been built in the country since 2014, and that's despite the number of eligible matrics increasing by 35% over that time. So there's roughly a 200,000 kind of university student capacity shortfall in the country every single year, and we think the private sector can make that gap up. There's a facility going up, quite close to here, Stadio. They're going to eventually build a facility that can house around 15,000 students. There's also a very big online opportunity. UNISA, I'm sure you read about UNISA in the news. They've got 400,000 registered students. Around half of those are on NSFAS funding, but the other half are not. And we think the private sector can take market share from that. And this opportunity exists absent any major uptick in growth in South Africa. So the one that we've got the biggest position in, it's around 5% of the SA equity fund at the moment. It's Advotech. It's a secular grower. It's been growing for a number of years. So SA nominal GDP, so that's GDP plus price. That's been growing just below 6% for the past couple of years. Compare that to Advotech, that's been growing revenue at 16% per annum. Learner growth's been 8.5%. I think that it's quite important to note. And that's versus the most recent number where learner number growth's grown by 10%. So law of big numbers don't seem to be applying. You'd think that if you're getting bigger, your growth should slow, but their most recent number, learner growth's actually accelerating. And we think Advotech can grow earnings at at least 15% per annum over the foreseeable future. Seeing I'm running out of time here, so I'll speed this up. The beverage can market in South Africa, we think that's also structurally growing. It's quite hard data to come by. So aluminium cans in the country are growing at 8% per annum. So way above what GDP is growing. A couple of reasons for that. Energy drinks market, I'm sure you've seen these on the shelves in the shops or people walking around with those Score energy drinks. The beer quart market, all used to be glass, that's moving towards 500 ml cans. And then Coca-Cola, you'll also notice this on the shelves, they're moving back to those 500 ml cans versus the plastic bottles that you're used to seeing on the shelves. So we're playing this through NAMPAC. There's been two kind of like negative announcements, which we think is an opportunity over the past couple of weeks, where we've been buying more. I've just illustrated here what kind of base case earnings are, the copper on the left, and what the potential is. They've got a lot of spare capacity. They've got business in Angola that is very much under-earning at the moment. There's a couple of reasons why that would grow. There's still efficiencies that they're taking out of the business. And the Reserve Bank of Zimbabwe, I think this is unlikely, but the market's placing zero probability on this, owes them R1 billion, and their market cap is R4 billion for context. Then, you guys have seen this. We're essentially back to pre-GNU valuations on a lot of the businesses. The SA markets, SA Inc. market is around 10 times earning at the moment, and we think this is providing exceptional opportunity in select names. Our largest holdings at the moment, so we've got Prosus Naspers, 15%, FirstRand, 9%, ABSA 6%, so backing the banking theme there. We have small holdings in some of the other banks as well, further down the list. Advotech 5%, the other one we've got Stadio, that's around just over 3% of the fund at the moment, so that's 8%. And then African Rainbow Minerals 5%. If you take all the businesses in the fund, which I would say are not entirely dependent on the country growing, so these kind of themes, that makes up around 25% of exposure in the fund. Then just a very long-term track record of Centaur. So again, context here from start to 2004, stock portfolios, that's how the business started. Everything post then is the flexible fund. Just remember the flexible fund has been very SA-centric. In the earlier years before my time, offshore would have only been 10-15% of the fund versus the 30% that it is today. So the track record was built in JSE equities. And then just in conclusion, we're turning 25 years at the end of this month. We've got consistent outperformance over that time period. There are specific pockets in the market we think offer great opportunity, valuations are attractive, and Centaur is sticking to playing its own game. Great. Gene?
Thanks, Nick. Questions from the floor? Yeah. Nick, very quickly, and I mean, you showed your performance history as well, and I mean, your flagship fund being the flexible fund, and I'll brag on your behalf. I mean, if you look over 15 years, #1 fund, it's always also been nominated the top unit trust fund, so I'll pop it in there. But again, I think, a lot of us are battling with portfolio construction. You've showed the numbers, we've heard it from other presenters. It was an underweight, overweight case for resources. It's also been a very strong case made on resources going forward, especially PGMs, gold, and the likes thereof, and things like copper. How do you manage that in the Centaur Flexible Fund? Because, I mean, again, if you were underweight, you did underperform. But how do you position for that? Do you stick to your guns? Do you ride it out? Where are you now?
So we've had no gold, and we continue to have no gold. So we're sticking to our guns there. It's simple. We don't know where the gold price is going. I know people have views on it, but it's very difficult to predict. It's maybe easier to have a view on the trajectory of it, but it's almost impossible to know exactly where it's going to go. And it's basically at the highest inflation-adjusted price in history ever, more so than the 70s. Then resources in general is case by case. So we don't go and say resources are X%, we need to own this % because of the benchmark. It's case by case where we find an opportunity. The PGMs are a little bit easier, I would say, than the gold sector, because you can have, we're positive on platinum as an example, because we can build a fundamental case there as to why. We're aware of the benchmark, we know what's in it, but we're not building the portfolio around that. It's case by case basis, depending on the business.
And fundamentals where you can see money to be made.
Yeah.
Nick, thank you very much for your time this morning. Thank you for coming through.
Cool. Thank you, Gene.
Right, last presenter on continuing on SA Equity, Dion Botha from Fairtree. Dion, thank you so much for being here this morning. You can come to the front. Are you at the back? We can play some music. This is going to take a while. Dion, thank you so much for being here. Appreciate it.
Hi, good morning, ladies and gentlemen. Thanks for the opportunity. So my presentation's a little bit different, some of the same themes, but I was asked to talk a little bit about the equity market from a top-down perspective. So I'm not really touching on stocks, and I'm also not doing any marketing today. So I'm going to create more time for questions, so please do jump in. Okay, so in a top-down equity market outlook, there's always generally we have to do our disclaimer. Today's disclaimer is a little bit different. I'm going to take us back 2 years. Think of most market participants would have told you, given the amount of interest rates increases that we've just stomached, that it's basic business cycle economics. We will see some shape and form of a slowdown. Most fund managers, most economists will tell you it's coming. It's the economy, stupid. In the short term, it was actually a little bit different. AI has told us, look, this is something you need to think about. You guys are not as smart as you think you are. And I think that's kind of core to our philosophy at Fairtree, is that you always have to take what is basic common sense principles and adapt to what is today. And today is a little bit different, but we know some of these serious drivers are still there in the economy. So that's why the US is continuously beat. If you look at consensus expectations the last 2 years, consistently above trend growth. US exceptionalism impacts the whole world. This year, 2025, we see a little bit of slower growth, mostly driven by Liberation Day policies and some of the impacts that tariffs have on growth expectations. But if we were to take the AI structural theme out of the market, you can see there right at the bottom, sorry, I'm used to having a pointer, you could see that we would be quite close to a contractionary environment for the US economy. So that's something we need to think about a lot in the SA economy. Remember, global growth, Chinese government, the US consumer are the two biggest drivers, and we as a small open economy, and our stock market is impacted by that to a large extent. So that AI capex, what I'm talking about, how big is it? How should we think about it? Well, it's a seriously big number in 2025. You can see moving just for these hyperscalers, moving from $200 billion to $400 billion. That is the injection that we are, that's the injection that we're seeing today. Now we can debate for hours about what is that $400 billion productivity. I mean, next year, probably the revenue generated for these companies is not going to be more than the depreciation on the capex. So it's not going to be a great thing on the income statement necessarily. But long run, this is an existential threat for many of them. So this money is going into the economy. But if you look to the other side of the graph, a lot of that money is going into real world things. Electricity, commodity demand, even for South Africa, something like ruthenium is very important in data center expansion. And we've seen that the other side, we have seen very little investment in commodities. So when we think big long-term, where are commodities in general going to go? Anything within this trend should be above inflation. So while we cyclically see some negatives, structurally, we do believe real-world assets can outperform above inflation and also just be general pressure onto inflation. So we've seen US inflation this year really spike, a strong spike with the tariff policies, but we've also seen inflation expectations, well, we'll see later today, but it's basically probably on par with South African inflation expectations, hovering in the high threes. So this really does ask questions about what we've seen come through in the bond market and what should be the cost of capital if you think about the dollar. And that's further, so when we're talking about all these risks coming up, the Fed is in a very difficult position. We've seen what is the labor, Friday non-farm payrolls, is the data correct? I mean, one moment Trump is saying, no, it's fake to the downside, and the next to the thing. So there's a lot of information that we need to take in every day. But the persistency in US unemployment as a lagging indicator as to where the real world economy in the US is something that is very difficult to bet against. This is telling you, you should be cautious. Some interesting things, and there's always interesting parts in the market, but this is something that we should think about. And I'm not going to comment to that part. I mean, it's well priced in the US market, but for our more cyclical parts in the South African market, we should think about it because times are uncertain. Big thinking, 100-year graph on the left, that's the impact, that's where tariffs are going. So just thinking that, we think this is going to happen because it happened 5 years ago. What's happening right now happened 100 years ago. There is some element of you need to adapt to what today is. And if you do not do that in your equity process, there are going to be some structural changes in the market. And also on the right, so the policy uncertainty is at new levels, both on trade and just in general economic policy. So a lot of questions being asked. And that has delivered why many have used gold as a diversifier in a 60-40 bond equity portfolio. If bonds and equities in dollars start to become positively correlated, I can tell you most asset construction in the real big pension funds, it doesn't work. You need alternatives, or you need gold. So that has been the driver of the gold price, incremental. Central banks, naturally also, we have spoken about it many times, with the US currently putting its foreign policy in a more direct manner, using some of the mechanisms that they've used against Russia. It's become clear to countries, if you want to be independent, you need to own less dollar and more gold. So these are persistent trends, but I think a more interesting component is we don't realize how liquid gold is. Gold is the second most liquid asset in the world. The amount of gold contracts on the physical gold is a massive multiplier. So it actually does not take a lot of demand. And we've seen interesting dynamics into precious metals. So I'm going to stop a bit there to think about when tariffs came into place. We weren't sure, is it going to be on, we thought gold was going to be excluded for a moment, there it wasn't. But we saw a lot of commodities move from London, Shanghai into the US. That created quite a physical tightness in other markets where we see these lease rates spike. Because basically you just used to go down to Rotterdam to go get your platinum, and now, no, sorry guys, all the platinum is sitting in New York because we were scared we were going to get a tariff and we tried to make a profit. So the dynamics in the market has been very fast evolving. But in general, these real world assets has done well, and a lot of what's going on today is saying that this might persist, even though you should be more cautious given the prices. The second, second kind of key building block I'm going to talk about is China. We've generally, always been optimistic on what China can deliver given its track record. Just going to need some water here. But the multi-year stabilization in the Chinese housing market is taking a little bit longer. So I want to walk over here. My mouth is so dry. Thank you, Eugene. So the Chinese housing market, it's been a multi-year process. We've seen lots of changes happen. 2016, 300 million tons of steel went into the Chinese housing market. It's 100 now. We've taken already 2/3 of the pain in the commodities. It's not such a big commodity driver. What it is a big driver to is the optimism of Chinese consumers and where we sit in that economy. So the prices have not turned. It's now almost 3 years of negative prices, depending what survey you look at. And unfortunately, on the right, you'll see that completions versus starts. I would have told you, I really like that starts to come down and completions to stay flat. That was the picture. Unfortunately, we are now seeing completions come down. So this is something that we think about when we talk about commodities, and why, as other speakers have said, not commodities are equal. And then on tariffs, so the Chinese have not completely, but have done a tremendous job to diversify themselves away from the US. So currently, you can see that they have broken away as a trade partner in the orange line. And Trump's policies as to replace some of low-end manufacturing out of China is going to be very difficult, given the unemployment rate. So this we are more sanguine about than some of the other risks. But we do think that China has got tremendous opportunities in structural elements in the stock market, some of which we obviously have access to on the local market via Tencent. But the overall theme is that you do not want to be betting big on top line in China. So you can see the deflation continuing. This is also a view where we were 2 years ago would have said we're going to see some movement here. A lot of dry capital in China. And so we're optimistic that if you can find great Chinese structural stories with margin expansion like Tencent, you should do well. For us on South Africa, we see signs of life, like other speakers have spoken about. So we see the PMIs pick up. Many of the leading indicators that we are following showing positive signs. Something that has not been mentioned today and at the conference this week is where do banks see credit growth? So we, as any capitalist market, the bank credit growth is probably the best indicator as to where the business cycle is going. And right across the board, acceleration. Most business for loan growth, bull cases we've compiled from analysts saying bull case is 6.5. So you can see that's not much of a pickup from the 5.8. You can see that line move, but we're talking to some loan officers talking about 8% nominal. Now that would be a real injection. That could be a catalyst to South African growth. We know about the other impacts. The gold and platinum fiscus impact from the current revenue price is going to be 30 billion. We don't need to talk about that at the next budget because we've got the 30 billion that we thought about in March, which is always very fun for all fund managers. So the rand remains in a position where we know it's always undervalued, but the opportunity there versus terms of trade is staying you. Maybe be cautious to be too negative on the rand, and that's because the real rates are high. So I, like other speakers, hope we see we've taken a lot of pain to anchor these rates lower. We've seen a lot of movement on that. I'm hoping the SARB feels a little bit more confident to give consumers that little bit of a boost that they need. So that's kind of the three key themes for us. The US, watch out, don't be, there's a lot of greed in the US market. Look at some of those macro variables. China, be on your feet, look for the Chinese government stimulus, otherwise it might be tracking along on the top down, and SA, where everybody's fearful, maybe be a little bit more greedy. So, yeah, thanks.
Any questions for Dion? Dion, I think it's getting a long stretch here.
Yeah.
Are you staying for tea?
Yes.
All right, so you can engage with Dion during tea time. Thanks a lot again. Lot to think about. Right, we're continuing on SA Fixed Income. Our first presenter, Nolan Wapner from Anchor Capital. No stranger to any of us. Nolan, thank you so much for being here this morning and starting on SA Fixed Income. Yeah.
Thank you very much. Hello, everybody. So I have been around a while. Okay, you're looking at lights on the stage. First time I've stood up here, but been around a while. A lot of you have met me previously, seen me on webinars, what have you. Name's Nolan Wapner, Co-Chief Investment Officer, Head of Fixed Income at Anchor Capital. In my youth, I actually worked in North America for Deutsche Bank for a couple of years, actually. And the most important thing I learned at the baseball matches is you've got a thing called the seventh inning stretch, which is where they just, between the sixth and seventh innings, they give you a chance just to quickly stretch your arms, stretch your legs. So please, everyone, it's already been a long session. Let's have a quick stretch. I'll talk a bit quicker to make space for it. 60 seconds, just stretch your legs, get some blood flowing, get blood to the brain, and we will chat. Don't go away. Don't go away. That's not my intention. Okay, so now that everyone's had a quick stretch, a bit of blood to the brain, I've got 12 minutes left according to the timer here. Eugene, I might run over. But what I wanted to do is jump in and say that the problem with fixed income is actually it's an incredibly boring asset class. It makes it very tough to be up here. And what makes it even more tough to be up here at the moment is the fact that the markets have been dead boring. And what I mean by that is every month I come in there, our portfolios have generated, or bond yields are maybe 10 basis points lower. It's about a 1% capital gain if you do the math. And on top of that, we've earned some interest income. Next month I come and the bond fund has generated 1.5% again. And it's just been an absolute fantastic environment to be an investor because every month, no surprises, bond markets are trending stronger. What do I talk about here? So what I said is let's just refresh what we said. And I'm not saying that we got it all right because to be honest with you, it was pretty obvious. Most of my peers got it right as well. We've been riding a big trend in the market. Point I'm trying to make is that the trends we've been riding should continue. If you're not invested in bonds, guys, get invested in bonds. Anchor BCI bond fund. So what did we say? First thing we said is that Trump was not necessarily going to fire Jerome Powell. Why not? Because he had other political mechanisms to actually achieve his objective, and Trump's objective is to see interest rate cuts in America. Trump's been successful. We saw that last night. Trump is going to continue to be successful. Interesting point, as the previous speaker was talking, inflation in the US is ticking upwards. The Fed has missed its inflation target for half a decade, and yet they're cutting interest rates, political interference. Where does that leave us? It leaves us with some interesting questions. Firstly, are inflation expectations in the US at 2% just too low? Do we need to recalibrate to 3.5% inflation expectations? And secondly, you've got to ask yourself, political interference, is that great? Come back to those questions in a minute and why it matters. But the second point I'd make is our Reserve Bank governor, and he is an absolutely fantastic Reserve Bank governor, albeit I have openly said I don't fully agree with some of the things he does. Specifically, he is pushing South Africa to a 3% inflation target. I think that the pain South Africa is going to incur to achieve that is potentially more than he is anticipating. That's why I've said I don't agree with him. But what I will tell you is that if he is successful, you are going to see long-dated bond yields come down. Bond capital gains going to continue. On top of that, South African government, cash raises from tax collection and debt issuance, bond issuance, is exceeding, expectations. At the moment, government cash balances are quite high. Realistic probability that they're going to slow down debt issuance. Great news. What does that mean? Bond yields coming down. This trend we've been riding for the last 6 months continues. From that perspective, we do think bonds are still interesting. But pull it all together, and the interesting point is Anchor believes in the purchasing power parity model for the rand. So what you've got here is a chart that shows you the blue bar, which is where we estimate the fair value of the rand to be, and then the little squiggly line, which is kind of where the rand trades. And as the previous speaker said, the rand is trading well above the blue bar. It means the rand is cheap. Go back to what I said earlier. Inflation expectations in South Africa, 3%. Inflation expectations in the US at 3.5%. Economic models suggest that the rand should actually appreciate against the dollar over time. Throw into that the positive trade balance, the high gold price. Throw into that the government cutting down debt expenditure or debt issuance, slowing down debt issuance. Let's rephrase that. What does it all mean? It actually means that from a South African perspective, I wouldn't bet against the rand yet. And certainly we're taking a more neutral stance. We have been saying for a while that the rand will continue to sort of edge out gains. It's going to continue. The rand's 1730-ish now. Realistically, could we test 16 by year end? Absolutely. And from that perspective, what I'm saying is do be invested selectively in South African assets. We like bond assets. Partly because we work for fixed income, but also because actually right now the trend lines and the economic environment around us continue to be positive for bonds. Having said that, as I said, I was just going to quickly, briefly go through what we've said previously, and the idea is just to say that the trend we've been on has a realistic expectation of continuing. On top of that, though, as fixed income managers, what I do, what all my peers who are going to speak after me do, is we look for other pockets of opportunity to bring value add to investors, to do something a little bit more with fixed income portfolios. And if you look over time, what has worked for a period and then changed. So what I've got here is just a chart showing the different things that were working very well. If you go back to the 2000s, what you will find is the buzz was to take listed property and blend it into an income portfolio. Listed property at the time was behaving very much like a supercharged inflation-linked bond. If you did that, you significantly outperformed. Fantastic idea, fantastic returns for investors, and it worked really well until it didn't, and when the listed property market shifted. Then what the next rage was, if you wanted to win yourself a raging bull, the rand was steadily depreciating through the Zuma years. All you had to do was actually just hold dollars, and whoever held the most dollars was going to get the raging bull at the end of the year. So that became the sort of rage and trend in fixed income for a period. Thereafter, you had the inflation-linked bond craze. You couldn't find inflation-linked bonds. I remember you'd phone around brokers chase that was just impossible to find until South African real yields were below US real yields, and suddenly reality dawned, and that reversed. The next big event has actually been the corporate credit craze, and I think that started in about 2018. South African tier 1 bank debt was trading at a credit premium of 7%. So you'd earn base country rates, we call it 6% plus 7%. You could buy a corporate bond paying 13%. Today, those credit premia have reduced significantly. What I will say is, in our view at Anchor, I don't think South African credit is expensive. I just think the cheapness is gone. I think it's about fairly priced for the risk you're taking. But the point is, it's increasingly difficult for your fixed income managers to add a lot of value here. So we started looking elsewhere. And you get to structured bonds. So what are we really talking about? We're saying you buy a government fixed rate bond from the government. You go to a bank, they give you an interest rate swap that matches that bond, and they'll issue you a new bond that sort of represents those two. Now, what you've done is you've taken out all the interest rate risks, so you end up with a nice, stable bond. But when you were doing that, you could actually earn a very attractive premium because the South African government bonds were in a bit of disarray at the time. So you could actually do this and earn yourself a 2.5% premium over 5-year bonds. I know, Anchor did the first bond of this nature in South Africa. Since then, billions of rands have copied us. But the point is, as people have done more and more of this, the premium that you earn has reduced. We earned 2.5% on a 5-year bond. I'm seeing today in the market some of my competitors are earning premiums of 1.7% by replicating 20-year bonds. Guys, you need to be careful as these trends change. Don't invest for 20 years to earn 1.7% a year. It's just not enough return. Yes, it's going to look smart today and tomorrow, but 20 years is a long time. So even, sorry, I've got the same water problem here, Eugene. But even, that has run its course. So where are portfolio managers looking at the moment? And 3 very key things. The first is structured notes, mixed rate notes if you want. Now, the idea here is you go to a bank and the bank says to you, what we'll do is give you a bond that for the next 3 years pays you a base rate plus 3%. At the moment, that would be a 10% yield. You're going to look super smart. You're going to have a portfolio yield of 10%. But in 3 years' time, that portfolio or that bond drops from a 10% yield to a 9 or to an 8.5% yield. Then you're sitting there hoping that that's enough. And we have seen a lot of these done. I think Standard Bank was telling us they've written 58 billion rand of this type of business over the last year. Significant amount of these in the markets. They don't resonate with Anchor because we battle to buy a bond today that might have a sting in the tail later. We don't know if we're going to be earning enough later when we're earning our 9% or 8.5%. So from that perspective, we don't own any of these. I'm not going to spend too much time on them. So now I need to drink some water. This is an interesting one to explain. So now what we're doing instead, firstly, is we like duration assets. So here's a chart that we draw up for ourselves all the time, and I'm going to point on that side if everyone can see it. So down the side here, you've got a list of all the South African bonds in issue, all the South African government bonds. Shortest dated bond, the 186 matures in about a year, the 2030 matures in 5 years' time. You can go all the way to about a 30-year bond at the bottom. Across the top, different interest rate scenarios. If you go to 0%, what you are saying is if market rates stay the same, nothing else happens, how much interest income am I going to earn on this bond if I hold it for 1 year? And the answer is if you own a 186 for 1 year, you're going to earn 7.32%. Not great. If we stretch that out and buy ourselves a 10-year bond, you're going to earn 9.56%. Much more appealing. And finally, you can go to a 20-year bond and you're going to earn 10.72%. Even more appealing. The problem with your 20-year bond has always been, but it increases the volatility. It increases the risk in my portfolios. So people are very cautious on doing that. Given the shape of our yield curve right now, actually that's not true. So what we say is, well, what if it goes wrong? Higher yields equals bad for bonds. So if yields go up at 25 basis points, so effectively one interest rate hike, the 10-year bond yields 8.11% over a year, the 20-year bond 8.74%. If you get 2 interest rate hikes unexpectedly, you're still better off in the long-dated bonds. A very unusual situation, doesn't exist often. But you've got this situation where even in the downside, you're actually better off in the longer-dated bonds right now. So from that perspective, what Anchor's been doing is all of our portfolios have systematically shifted towards the long-dated bonds to take advantage of this. Over the next 12 months, you are going to be better off. So from that perspective, we do think duration is a good place to be. Mentioned it earlier, Anchor BCI bond fund. Final point I'd make is that we are also looking outside of South Africa. South African credit spreads have come down tremendously, but there's a whole big world out there. And you can invest in other emerging markets. Not Russia. I put the Russian flag on there because we kind of got it as a package with a BRICS image I chose. We're not investing in Russia. Okay, please. What we have done, however, is we have gone to Brazil, a bit further left. We've bought Brazilian bonds and structured those. South Africa, as I said earlier, we did the first South African structure. We earned 2.5% premium for our investors. Brazil, I'm actually earning about 3.5% premium. So we're earning even more. The economics, I see our economist sitting there in the middle, so say hi to her, she'll explain it to you. The economics in Brazil actually aren't too dissimilar in terms of risk that you're taking in South Africa. From that perspective, we actually like looking at emerging market bonds as well. So take a little bit of risk on longer dated bonds, take a little bit of credit risk, be a little bit more open-minded, take a diversified approach. You're ending up with a more attractive, more appealing portfolio for your investors. Ultimately, it should give you a much better experience over the coming years. What worked in the past is not going to work when you look at the special opportunities, and the trend line we're on continues to be good. So why anchor? Because we're a small team, we're a nimble team. We are looking at these opportunities. It's no accident that we did the first structured bond in the country. It's no accident that we actually did the first credit repack as well. What we continue to do is look for these opportunities to do something smart for our investors, to bring something extra to the table, and that's all that, that's what we're about. Please do reach out. Thank you very much, Eugene.
Make you work hard for your money up here, Nolan. Thank you so much.
And I'll squeeze in a stretch for everybody. Guys, there's the disclaimer if anyone asks. We did show it.
Nolan, sorry, just very quickly, and I mean, your presentation's been very clear. I just want to look at global bonds briefly. You are packaging the emerging market bonds. About 18 months ago, when we looked at yields on US bonds, they also seemed fairly attractive. We know by now that yields went up further. But US bonds I find particularly interesting at the moment because it almost seems like you can't invest in it anymore. Because yields can just potentially keep on going up and the US is massively in debt. What's your view on US bonds?
Under a normal economic environment, yes. Trump is not a normal economic environment, guys. And specifically, what he is systematically doing is taking over the Fed by appointing different people in positions. He's appointed Moran, who voted for the first time yesterday. Moran, incidentally, the only dissenter for the rate cut. He wanted more rate cuts, so we know which way Trump's trend line is going. Now, where this comes out and where I'm going with this is that the Fed actually has everyone talks about a dual mandate. It's actually a three-part mandate. And their objective is to keep inflation low. They've failed. Inflation's going high, and they kind of turn a blind eye to that. It's to keep at full employment. I would argue that employment in the US is actually full and is going to continue to be full. Yes, the job numbers are lower, but guys, if you're deporting all your workers because they happen to not be born in your country, what does that mean? It means you've got less people looking for jobs, which means your jobs numbers are going to go down. So that is actually quite a realistic scenario, and it's going to continue like that because it's actually the new normal. And then the third aspect of the Fed mandate that people don't always talk about is that they need to keep interest rates at a sort of reasonably moderate level. Now, the point is that Moran, when he arrived at his Senate confirmation speech, made a big thing about this. So what's he really saying behind the scenes is, yes, markets might try and push up interest rates, but that's fine. We've got quantitative easing. And if we don't like what the markets are doing, that's the next step. I don't think the risk in US is that big, but then again, I actually don't think the upside is that big either. I think your upside is better in South Africa. I think your upside is better in emerging markets. That's why we're investing there.
Nolan, thank you very much for that. Appreciate your time. Yeah. Continuing on SA Fixed Income, Sidney McKinnon from BCI Asset Management. Sidney, good morning, and thank you for joining us this morning. We always have you at the Cape Town venues, and it's really great to have you again. Thank you.
Thanks, Eugene. Always good to be here. I came prepared with my water, so hopefully my voice lasts. Okay, thanks everybody. Great to be here this morning. Always good to be part of this BCI session. My name's Sidney McKinnon, and I'm CIO of BCI Asset Management. We have specialist fixed income house. So for those of us that don't know me, I'm here to talk about fixed income, and I promise I will. But I thought I've entitled my presentation "Meteor Showers and Shooting Stars." Now, there's a phenomena that happens on an annual basis. Actually, it happens every month, but at different points in the month, where we have a celestial event where the Earth orbits crosses that of a meteor or an asteroid. We had one in August this year. It was called Perseus, if I got the pronunciation right, where we got this comet called Swift-Tuttle. I think it's 109 Swift-Tuttle or Swift-Tuttle, that has got all this debris that follows the comet, and then the Earth orbit passes through it. And then what happens is you have these dust particles that, or these particles that when they enter the Earth's atmosphere, they start burning up. And it actually creates quite a spectacular show. I put up a slide. So this is what it looks like. But you've got to find the dark corner in the world somewhere, hopefully in the northern hemisphere, and then be prepared to sit up past midnight, and you'll see quite a spectacular show. And the reason why I'm talking about meteors and shooting stars, because it made me think that our fixed income environment's not dissimilar. Because with all of these events, like meteor showers, even though it's chaotic and it's quite beautiful, but there's a measure of predictability in it. Actually, there is every month we've got almost every month of the year we've got a meteor shower. The most spectacular one is in August. We know it's going to happen. We do have the predictability. We know as I said, if you can find a dark corner in the world and watch this thing happen, it's quite spectacular, and it happens in August every year. We know that. Similarly, our bond market, we know we get coupons from our bonds. We know when it's going to happen. Every month, well, every 6 months, generally, you get a coupon from our government bonds. So, just going back, even in uncertainty, there are patterns that we can rely on. You know you're going to get your bond coupons at a particular point in time. The trick is, you know that the coupons are there, but you don't know what the returns are going to be. You can't exactly say, and I know Nola's been saying, yeah, stick with the bonds, we're going to be getting great returns, but if anybody can tell me exactly what returns you're going to be getting, then I think we can all just kind of switch off and go and play golf and make lots of money. We have to manage those unknowns. And those unknowns are defined by the conditions that surround the fixed income markets or markets in general. So, like with the meteor showers, if the conditions are right, it's nice and dark and it's a clear night, you can get quite a spectacular show. But if there's lots of city lighting, you're not going to see much. So, what conditions are prevailing in our markets at the moment? And I'm going to go through a few from the international side. And forgive me and indulge me, because I know a lot's been put up on these screens already that we've seen. I'll give you my take on it, and just to sketch what those conditions are at the moment. And the first one from an international perspective is, of course, global growth. And a lot has been spoken about global growth this morning, but we know that it's been resilient, but now we have all these policy changes coming into effect. And that's going to be quite challenging going forward, especially with the tariffs we've seen. And then, of course, the drop-off in U.S. consumer confidence. So the global outlook is becoming increasingly challenging. And what does this mean for fixed income assets, especially from a global perspective? Theoretically, this keeps a lid on yields, lower growth. And I think Nolan mentioned that early on, we've got this sort of tension between growth on the one hand, and then, of course, inflation on the other hand, because inflation's ticking up slightly, but I'll chat about inflation in a second. Actually, it's my next slide, so let me talk about it now. So we've got inflationary pressures that have resurfaced in some economies, and there's expectation for it to potentially move higher as well. Why? I think the first thing is that it's mathematical. We're coming off a low base, so everybody looks at inflation on a year-on-year basis, and so naturally it's going to tick up. But there is some inflationary pressures, and we've seen some goods inflation numbers that are rising as well. And then, of course, the uncertainty as far as tariffs is concerned and what effect that's going to have on inflation is still unknown, and I think that's going to take a little bit of time for that to move through. What does that mean for bond yields, especially the US bond yields? Because embedded in bond yields is expected inflation. So that's going to put a bit of upward pressure on your bond yields. The third condition to watch our meteor showers show is monetary policy. So we've had the Fed last night cut by 25 basis points. But I think it's a lot more complicated now, not only because of just the structural framework and the data that is coming through, but because of the almost political noise that's surrounding monetary policy at the moment. I think Nolan also mentioned, and previous speakers have mentioned, those governors that are now part of that enclave and who they represent and what their thoughts are. So monetary policy across the world becomes very, very complicated in terms of what central banks are going to do to use monetary policy as a tool. If we remember, monetary policy is there as a tool to control or to influence the activity within an economy. And that's what you're trying to do with monetary policy. So, policy rate reductions can continue in certain economies where inflation is projected to moderate. But I think we're in for quite a complicated session as to how long it's going to take, how long it's going to be applied, even though the feeling is that there will be rate cuts coming through, and I'll speak about our local environment in a second. So we got this from a global perspective, and I'm only sketching 3 conditions that's clouding the night sky for us to watch the show. That's your global growth, your inflation, and monetary policy. And I think you got to find that dark corner to see the nice meteor show is becoming increasingly difficult from a global perspective. From a local perspective, I don't have to tell you, we all know the story as far as growth is concerned. We've got subdued growth. We have growth projections, forecasts that have been revised down by all kinds of parties, including our Reserve Bank, and then we've got the global trade tensions, and then, of course, low inflation, but we've still got high unemployment, low business confidence that is adding to local growth. Also keeping rates down. And for the bond market, it's not a bad thing because you're getting capital gain when rates are coming. You're getting your coupon, predictability, and if rates are being kept down, you're actually getting that nice gain. And Nolan showed a nice slide about where you can actually get that gain in the bond markets. And then, of course, local inflation. My slide's a little bit out of date. This is from July, where the family braai had become a bit more expensive. While food prices, I saw the latest numbers, that's moderated a little bit, so maybe for Braai Day on the 24th, I think it is, it will be a little bit cheaper to have your braai than it was a month or 2 ago. But we've had utility rate increases, watch out for food prices, and then, of course, but we are coming off that low base, so don't be fooled by the mathematics. It just means that you're coming off a low base, and therefore there's a bit of pressure on year-on-year inflation. But the SARB is talking about this 3% inflation preference in terms of the target. So I think there's a real commitment by the SARB to actually target low inflation, which they've been unashamedly prepared to say that is what they're trying to do, which goes on to the next point, which is local monetary policy. SARB's unashamedly said, look, we're targeting lower inflation. We prefer lower inflation. I know there was a bit of a spat between the Treasury and the SARB in terms of the way in which that gets portrayed to the media, but hopefully they found each other now and they can kiss and make up. But the SARB has lowered its growth forecast. And if there is further rate cuts and there's higher inflation coming through, it's going to be a bit challenging. But if we get a rate cut today, I think that's positive for our market. And I think we as a house, we are leaning towards, we took a poll in our business yesterday, and we are leaning towards a rate cut this afternoon, but that remains to be seen. But so there's these conditions from a global perspective, and then from a local perspective, low growth, keeping rates down, inflation with a bit of pressures, maybe from food and core, which gives a bit of upward impetus to yields. And then, of course, monetary policy, which inevitably looks like it's going to be trending downwards, which will also keep rates lower. So good for the bond market. There's a little culprit that, not so little, that tends to influence our market. From our perspective, when we look at the interest rate environment, I've only sketched some of the conditions that's clouding the night sky in terms of the show that we can see. But there are many, many factors that drive our bond markets or our fixed income markets. And people tend to have hot buttons. Right, it's the US, it is tariffs, it is inflation, it's monetary policy, whatever the case may be. But our rand tends to have quite an influencing, to be quite an influencing factor when it comes to our interest rate environment. And I've listed these things all thanks to ABSA, and a lot of it's political as well, up until the point where Trump implements his tariffs, and I suppose I could enter one or two more. So there will be volatility in our currency as well, which tends to translate into our bond market as well. It's not all doom and gloom and volatility, because I think if you look at our market carefully, there are extraordinary events that happen that you can take advantage of. They do occur. And thanks, Nolan, that was a great slide. I think you actually put a lot of those events on there, which was inflation-linked bonds. It was the fact that you could get credit spreads narrowing. If you were buying the banks a couple of years ago, you could get decent credit spreads. Unfortunately, that has dissipated now, and yes, I agree with you. We have to become quite innovative in the way in which we can extract value out of this market. But extraordinary events do occur. It's for us as managers to be able to spot them and take advantage of them. So, most certainly some of the funds that we manage at KDs, we've managed to take advantage of that narrowing of the spread. That's just one, because what happens is, if occasionally you get these fireballs from the meteor showers, which is quite big, but they don't last forever. They tend to burn up quite quickly, but it's very spectacular. So if you can take advantage of that, that's great. I think it's important that all good and well to spot all these factors that are influencing the market, but you have to position yourself. You need to be able to say, look, okay, so how do I want to prepare and position for what is coming? How am I going to be positioned along the yield curve? All bond fund managers love this thing called the yield curve. But it really comes down to that at the end of the day. What am I actually going to be purchasing? What am I going to be buying? What am I going to be selling? And is it really the case now that I should be maybe shortening duration because of the inflation trend and buying, or because of the growth trend and buying shorter-dated bonds with a high current yield, so I get or should I be lengthening duration to take advantage of a lot of the factors that have been mentioned this morning in terms of lower monetary policy, low growth environments. And I'd like to show you what we are doing at this point in time as KDs. And this is just a chart which depicts our conviction, because it's good and well for me to stand up here and talk about all these great things that one should look at, but we need to make it real. We need to filter that down to our portfolios and actually implement that in our portfolios. And as bond managers, we like to say, I'm long or I'm short. What the heck does that mean? It means that you're changing the sensitivity of your portfolio to take advantage of the directional movement of interest rates. And for a while now, we've been in a long position, thank goodness for that, which has served our portfolios quite well. But it's no coincidence. This is a result of our investment process that is very comprehensive, that takes all the factors, and I've shared with you a few of those factors this morning, that influence the directional movement of interest rates, and we're still in that position to take advantage of the downward trend. So a little bit of marketing. You can see that in our funds, in this fixed income space. In the multi-asset space, we've got an enhanced income fund, which is quite sizable inside of Reg 28 compliant, and it uses credit, uses those fireballs, it uses it very well. We're looking for other opportunities at this point in time, and it uses a big diversification strategy, but we can, I challenge you to go and have a look at the returns and the way in which this fund has actually performed on a risk-adjusted basis and achieved its objectives consistently over time. We do have an absolute yield fund as well that uses asset allocation, because you can use credit and you can use diversification, but you must be able to pick the right assets. So whether you're buying bonds, nominal bonds, inflation-linked bonds, or floating rate notes, this fund takes advantage of that, and similarly matched to our overall arching investment process, it's delivered the goods. So like meteor showers, the fixed income rewards those, or the fixed income environment rewards those who are patient, prepared, and positioned. I didn't realize that's 3 Ps, but okay, patient, prepared, and positioned for the right environment. You'll be able to see a spectacular show. So that all remains for me to say is thank you. And for my colleague at the back of the room in Tsonga, let me get this right, Hope Nzakenza, who helped me put this presentation together. Thank you.
Certainly, thank you very much. I just picked up on that as well. On the big screens, the scatter charts that you put up,
Yes.
it didn't actually show all the other funds. We are going to share the presentations, but if you want to go look at that scatter chart, it's actually really impressive. Your risk-adjusted returns relative to the group, but very interesting indeed. No questions from my side. Any from the audience? Right, certainly thank you very much again for being here.
Thank you. Right. Thank you, Jim. Thanks, everybody.
Continuing SA Fixed Income, JP du Plessis from Methodical. JP, thank you so much for joining us this morning. Why don't you see how you put a different spin on fixed income?
Well, I'm going to try. Good morning, everybody. Thanks to BCI again for putting this all together, and thank you all for attending and spending the morning here listening to us folk. As Eugene mentioned, I'm JP du Plessis. I was working out on the drive here how long I've been in fixed income markets. I think it's 28 years, probably longer than some people have been in the room. But I still enjoy it, still love what I do, and still love managing money. The most important I think is that, and I'm going to bore you instantaneously when I say this, but we kind of consider ourselves risk managers. That's kind of what we do. It's looking and assigning what risks are attached to every kind of environment. So I'd like to thank Nolan, who presented just before, for giving a good example of risk management. So when he invited you to all stand and take a deep breath, what he was thinking of was you guys would all take in more oxygen and then be able to pay more attention to what he was saying, okay, and understand what he was saying. But what he didn't anticipate is that it also gave you the opportunity to leave the room. Now, what's the risk reward there? If you look at it pre that decision, you'd think there are 4 fixed income managers who are about to present, okay? What are the chances of people leaving the room? It's got to be pretty high, right? So when you look at that risk reward, you really got to manage those risks. So unfortunately for you, that means there's no stretching and there's no opportunity to leave the room on my presentation. Okay, that's my side note for the day. My subtitle for the presentation is a lot of questions and hopefully a few answers. This presentation was done about 2 weeks ago, and the glorious thing about what we all do is that markets move, things change, data comes out, and the risk-reward balance changes as time goes on. So I've got a lot of questions. Some of the answers are sort of slowly being given to us. Some of them are maybe a little bit more obvious. So I'll let you read through them. The first thing is what's happening in the US. So obviously we had the Fed last night, and I'm sure you all saw that they cut interest rates by 25 basis points. Their dot plot said, "Oh, there's another 50 coming for the rest of the year, another 50 basis points." And then and the market got very excited, and then Jerome Powell came out and said, "Hold your horses. We're actually really worried about what's happening in the jobs market. We're worried about what's happening in the economy, and we don't think we necessarily have slayed the inflation beast." Interesting comment about last night is that they anticipate that they will get back to their inflation target by 2028. Now, that's a long time away, last time I checked. And that's basically the Fed putting up their hand and saying, we don't actually think we're going to get, we're not actually as in control of inflation as, as we think we ought to be. So the job market, this is just showing the rolling 3-month averages of job creations. Now, it was mentioned before that you don't need to create as many jobs when you're not when you don't have as many workers. So obviously this whole foreigners coming over the border has been stopped by Trump. So there's less workers to create jobs for. But nevertheless, the trend is quite disturbing. And when you've seen this downward trend in history, like we've seen, and this actually doesn't include last Friday's, which was lower than expected, then you tend to have a slowdown. Now, the gravity of the slowdown can change. Obviously, we saw a big slowdown in COVID. We saw in the global financial crisis, the dot-com boom. But you can see they all show that trend, and that's actually what the Fed is concerned about. That's why they cut interest rates yesterday. The second question is monetary policy really that restrictive? If we look at it, I don't need to tell you guys. If I look around the world, I don't see markets that don't show a lot of froth. If I look at credit spreads globally, they're very tight. If I look at cryptos, they're at new highs. If I look at stock markets, they're at new highs. I don't see massively restrictive monetary policy as we stand at the moment. And we've seen, this is just showing you monetary supply. We saw a massive creation in COVID. Obviously, they were worried about the global economy just stopping completely. That fed through to higher inflation. And then post-COVID, we've had some neutralization of that growth in monetary supply. But we started to see that tick up again. And actually, if you look at where it is right now, it's kind of at the level that you've seen over history. So I wouldn't say it's particularly restrictive. This, I'm not going to take you through this specifically, but this is a reaction, my reaction to Scott Bessent, who's the Treasury Secretary, saying a few weeks ago that there was no model out there. Didn't exist a model that didn't say that they should cut interest rates. Well, there's about 20 models out there that says they shouldn't cut interest rates, including the Taylor rule, which has been around for 40 years. And that just looks at where inflation is, where the output gap is, and where inflation and unemployment. And it says actually that interest rates should be higher than where they are today. Now, it's a rough guide. It moves around, but there are plenty of models that say actually interest rates should be higher today than where they are. And nevertheless, they've cut. I do think my conspiracy theorist on this is that Trump is very much playing a game with the Fed, and that he's using the Fed as a scapegoat and putting these headlines, they should be slashing by 150, 175 basis points, is creating a scapegoat in case the economy falls off a cliff. Because in a year's time, if those jobs numbers slow, we enter a recession, he can blame the Fed and say, guys, it wasn't my fault. I told you the Fed should have cut rates, and they didn't. So it was all their fault. Very clever. Sometimes I think he's not given enough the benefit of some of the things that he does. We talked a little bit about inflation targeting in SA. My comment about the Fed was more around central banks thinking they are maybe cleverer than they are, and maybe have more control over inflation than they really do. And we've seen that from the Fed. Now, if you think about central banks globally, you'd say that the Fed, with its 1,000 PhD economists, would really understand where interest rates need to be set in order to control inflation. And yet they've basically thrown in the white towel, saying they're not going to be able to get inflation back down to their target level until 3 years' time, maybe 3 years' time. Our central bank thinks that they've controlled inflation, so much so that they actually just moved all of their models down to 3% as soon as they announced that 3% new target. Obviously, that's somewhat controversial. But what's really driven inflation and big bouts of inflation has been weakness in the rand. So when we've seen big bouts of inflation, yes, we have food prices which come up and down, and food prices can also be influenced by the price of by the rand with imported oil prices, and a lot of that is is outside of the control of the Reserve Bank. Yes, they can put interest rates up to try and attract more capital to South Africa, but that's quite a blunt tool. And if we look back to the beginning of inflation targeting, our inflation has been 5.9. So again, I did this 2 weeks ago. We had inflation which came out at 3.3 yesterday, much lower than expected. But what were the things that really drove that inflation lower? Food prices were unexpectedly lower, and then the cost of transport, i.e. the cost of fuel, because of the rand oil price, was much lower. It was negative over the year-on-year basis. And those are things that really the Reserve Bank doesn't control. You can see here that it's there's a lot of noise about how they've moderated inflation expectations. Everybody relax in the room. Nobody expects inflation to be higher than 3% going forward. And this is just looking at the BER inflation expectations versus where inflation has been. So the blue line is inflation, and the red line is inflation expectations. Now, the question really is, which one is leading the other? Is inflation expectations as a result of having lower inflation, or is inflation as a result of lower expectations? I would argue that a lot of inflation expectations are around current or recent inflation posts. So when you get inflation at 3.3, then people start to moderate their expectations for inflation going forward. But guess what? If inflation came out at 6 in a few months' time, people will start to panic and think actually inflation's going up. So you've got to kind of see it in that light. There is concern about, where's my timer, Eugene? Or we just flying 5 minutes? Okay. I just want to talk over and take off the feather. So what's happened in global markets is the long end of the global bond curve has sold off. Actually, we had a bit of a rally over the last week, but it's sold off over the last 6 months. And that's as we see concerns about that supply picture coming into global bonds. So you can see in this chart, we've got the US, we've got the UK, and we've got Japan. The short end of the curves has actually been flat or actually come off, i.e. they expect interest rates to go lower. But if you look at the 30-year part of the curve, it's actually sold off. So they're worried about that supply coming in and that fiscal sustainability. South Africa has sort of been the odd one out in that our long end has also rallied with our short end. And that I think is largely down to the fact that we've had our repo rate controlled, our inflation controlled, and there's been what I would call a late cycle flow into EM debt. It was very interesting to listen to some other presenters today talk about markets that we haven't heard about for quite a while. When you start talking about frontier markets, I just get, as I said, I've been in markets for a long period of time, as a few people in this room have as well. And when you start to hear things about, we're finding new markets, and we've kind of seen this movie before. When people go up the risk curve, suddenly get involved in local EM debt, it tends to be quite a frothy market. Okay, I can see I've missed the clock the whole time. We've looked at the yield curve. Sydney had it. I do believe no fixed income presentation is complete without it, but I'm going to go skip through that. So what am I looking at the moment? So I still like inflation-linked bonds. Weirdly, even though inflation is low, it protects you from inflation. I haven't quite drunk the Leseche Konyaku Kool-Aid. I don't quite believe that they've controlled inflation. I think a lot of it has been driven by circumstances outside of the central bank's control. And I would be very interested to see the kind of cognitive dissonance if suddenly inflation goes up and the Reserve Bank goes, well, we don't know what to do now because we said it was controlled and now it's gone up. And in fact, that could be quite an interesting scenario where the SARB has to deal with that. So I still like having them in the portfolio. They protect the portfolio. I've got two funds. One is an income fund, so that's what I call my widows and orphans fund. That's SEFI plus one. It's safe, secure, steady, nice, smooth run rate. And then we've got a dynamic income fund, which is a better of bonds and cash. So this is more favored towards the widows and orphans fund, the income fund, steady returns, protecting from inflation. Obviously, inflation is the enemy of savers. I still like the belly of the curve. That's that very steep part of the curve in the middle here, where you can capture some of those additional returns from that steepness, but not go too far out. And then I still like having some exposure outside of SA, because again, it's that rand weakness that tends to drive inflation and inflation expectations. That's my story. Thanks very much.
JP, thank you so much. I had a couple of giggles in that presentation. Thank you very much. Any questions for JP? Nothing from my side, and thank you very much for being here today.
Thanks.
A lot of diverse views on fixed income and bonds and inflation and where we're going, and I think that's the point of why we sometimes blend income funds. Next up, Brandon Quinn. Brandon, thank you so much for joining us this morning. Last speaker before we break for tea.
Yes.
I appreciate it. Thank you.
Thank you. All right. Yeah, thanks again to BCI for organizing this event. It's always a pleasure. Yeah, my name's Brandon Quinn. I'm the CIO of Saffron Wealth. We're a Category 2A hedge fund company based out of Stellenbosch. I have the privilege of leading a great team of predominantly younger individuals than myself. We're an active manager. We utilize quant-based strategies to try and unlock value for you across a number of both fixed income, hedge fund, as well as equity strategies. So on the fixed income side, we've got our Opportunity Income Fund, which is the kind of low-risk income-based proposition. We've got our Active Bond Fund, which is a very active long-duration fund. I urge you to have a look at that. We've got our Global Enhanced Income Fund in Ireland, which is a dollar-based cash-enhanced income fund. And of course, we've got our Flexible Fund, which is an equity fund that uses the concept of portable alpha to enhance returns. And that Flexible Fund has now been running for 3 years, and I think we've attracted about 670 million already into that fund. So in equity space, I think it's doing pretty well. So from where does the rubber hit the road with regard to our quant strategies? How do our quant strategies stack up against both our competitors and the market? And of course, the only real measure is risk-adjusted returns. So if we have a look at the risk-adjusted returns of our Opportunity Income Fund, you can see that it stacks up very, very well. And this is over a 10-year period. So why do I bring up long-term track records? Well, because Saffron has been, our funds have been around, or the majority of them, for more than 15 years, which means that we've managed our investors' money through cycles. We've managed through, exceptionally good times as well as exceptionally bad times, specifically in emerging markets. And our numbers stack up on a risk-adjusted basis. Our Active Bond Fund in particular is interesting because from a volatility point of view, we deliver superior returns at almost half the level of standard deviation or volatility over a very long period of time. So that really is where we think the rubber hits the road. Both funds right now have very attractive yields. Our income fund has returned about 10.3%, and that's in our 100 basis point fee class. And our bond fund over 1 year is sitting at about almost 15% after fees. So I think both pretty good returns over the short term as well. In the global space, you can see there again a significantly enhanced yield, and that's our global fund sitting at almost 6% over a 2-year period, and at about 0.75% volatility. So that's definitely 0.75% vol for a 6% after fees dollar return is a very attractive proposition. One of the key things that's important to realize with regard to our funds is we don't have any private credit. Why don't we have any private credit? Because of the liquidity constraints of private credit. All of our funds are incredibly liquid. And given the recent events in South Africa, we're even more convinced that this is the right way of managing money. Let's call it a 7, I think that's a 4 or 5 liquidity day period, about 80% of our fund can be liquidated. So that means that literally we can convert 80% of our fund into hard cash within about 5 days. So that very much is a hedge fund approach to the management of money. We are here today to talk about bonds, so I'm going to talk briefly about the tailwinds and the headwinds that are facing the South African domestic fixed income market. I think from a tailwind point of view, we definitely are in a cutting cycle, both domestically and in the US. Dollar weakness or rand strength? Is it really rand strength? No, it's not. The rand is not strong, the dollar is weak. That really is a key differentiator. And as a result of that, the rand strength has obviously resulted in better inflation numbers, and of course, to some degree, improved terms of trade. But really, it's not about rand strength, it's about dollar weakness. In terms of tailwinds, there's definitely excessive demand for global emerging market credit and emerging market sovereign debt. From a supply point of view, it's like we envisage that the central bank of SARB, or Treasury rather, is likely to decrease longer-dated credit bond issuance, and in fact focus more on the short end of the yield curve. And that would make sense because our yield curve is so steep. So in order to minimize the cost of funds, there's obviously a tendency to focus on the cheaper part of the yield curve, which is the short end. And that we think is going to play very nicely into our bond returns. Inflation targeting, frankly, I think it's completely inappropriate. Where we've got unemployment where it is, where we've got growth where it is in South Africa, I think that inflation targeting, which by definition means that you have to be keeping interest rates higher for longer, is growth inhibitive. And I don't see that as being appropriate for our economy right now. Another tailwind, and this of course is one of the lowest probabilities, that's why it's last on the list, is of course a surprise event coming out of China. China has embarked on a couple of really large stimulus packages over the last, call it, year and a half, 2 years. They haven't really done much. There's still a tremendous hole in the Chinese property market, but there's the potential for an outlier to surprise us there, in particular in the base and industrial metals complex, which South Africa is so dependent on. Headwind, obviously it's a lot of, let's call it government or administrative mismanagement. We've seen that in the form of the NERSA adjustments, which is constantly putting pressure on consumers and consumer spending in South Africa. The current weak Chinese market is still a detractor. And of course, our deteriorating SA political environment, but we don't need to go into too much detail on that. We all know that all too well. From a quant's point of view, it's really worthwhile taking or giving a revisitation of the real drivers of our bond market. And here we run a live what we call, or what is called, a factor analysis. And you can see there, I hope it's clear, is the 2, 5, 10, and 30-year points on our yield curve. And what we do is we try and understand what are the main drivers of each point on that yield curve. Because, of course, taking a position in a bond market is about two things. It's about shape and level. So it's important to divide up the curve and to understand what are the drivers of each component of the yield curve. The red bars indicate the repo rate. So that is the component that is controlled by the SARB. And you can see that it diminishes over time. In the short end, it comprises about 67%, or explains about 67% of the movement in the short end of the curve, and it diminishes all the way down to 24% in the 30-year part of the yield curve. What's important in the long end of the yield curve, and the long end of the yield curve is of particular importance. Why? Because it's the most of the duration on the All-B index actually is in the long end. It's disproportionately here. And you can see that 74% of the 30-year, the South African 30-year point can be explained by movements in the US 10-year. So it means that you need to focus on what's going on in the US to understand 74% of the movements in the SA 10-year. And I'll get back to that shortly. If we cut to the chase in terms of what our expectations are with regard to the South African bond market, what we do is we take the All Bond Index and we stress test it to understand what the return dynamics are of the All-B. Given the fact that we are in a rate cutting cycle, and we saw that the central bank or the Fed cut rates by 0.25% last night, South Africa is probably likely to do the same. The forward rate curve also indicates significant further cuts likely to eventuate. If we assume a 100 basis point cut or cuts over the next year, what would the return of the All Bond Index be? And the return of the All Bond Index would be 15.5%, which is a tremendous return given the fact that inflation is only sitting at about 4%, which gives you an 11% real yield. So our view right now is that you have to really have a high degree of commitment in other asset classes that will exceed an 11% real return over the next year. So bonds for us are an incredibly attractive asset class to be in. If, for example, we only get 50 basis point cuts, and bearing in mind that we wrote this presentation almost a month ago, so it's somewhat outdated already, 50 basis point cut would result in a 12.5% return on a one-year basis. So those are very, very attractive yields that we think our domestic bond market can offer you. This is basically just telling you or demonstrating what I've already spoken about, which is that there were about, or when I wrote this, was about 4.5% worth of cuts, 4.5 rate cuts of 25 basis points each priced into the US market. So definitely in a rate cutting cycle, but certainly it's not immediate. This is over a 2-year period. So it seems like the market is expecting a protracted rate cutting cycle. If we look at US inflation expectations, previous speakers have said yes, that there's, it has been rising. But what's interesting is the Fed doesn't need inflation to be at the 2% target rate in order to cut. In fact, it's very rare that they cut at that 2% level. The Fed is more interested, frankly, in growth and employment. And this is really the crux of why the Fed cut rates by 25 basis points last night. The US employment rate, obviously, or unemployment rate has started lifting. If we look at labor force participation, so this is the number or the percentage of potential, potential employees that can work or that are working versus that can work, and that's about 62%. So only 62% of the labor force is actually working in the US, and that has somewhat diminished over the recent past. I know I'm running out of time here. I've got 44 seconds, Eugene, so I know you're watching that clock. Importantly, if we think about the labor market concerns, this really, I think, captures where the Fed's mindset is right now. If we look at 2023 and the labor market in 2023, you can see there is the first release, the dotted line, and the final revision is the solid line. So that's 2023, that's 2024, and the red is 2025. In 2023, there were 252,000 jobs that didn't exist, that were measured with the first print, and that were revised to not exist thereafter. In 2024, there were 241,000 jobs in the US that didn't exist, that they thought existed. This year, okay, and bearing in mind that we are at a much lower trajectory to start with, there are 461,000 jobs that were measured that don't exist. So the Fed is concerned on a couple of levels. Number one, the absolute level has been diminishing. And number two, the growth in the error factor has grown exponentially. So their confidence in the labor number has diminished. If we're thinking of South African bonds, yes, we're going to get a 25 basis point cut tonight. I'm pretty sure of that. We obviously have to be careful of the fact that if we cut our rates too much, our carry rate diminishes and our rand weakens. If our rand weakens, energy imports become more expensive, and that puts pressure on our inflation. So I know I'm out of time, so I'm going to rush through here, bearing in mind that the SA currency is mainly a metal story. So it's about iron ore, it's about precious metals, and of course industrial metals. Credit spreads, too tight. We think credit spreads are too tight for our liking. I know previous speakers have spoken about South Africa being fairly priced. We believe it's too expensive, and we've been on a reducing trajectory for at least a year now. So slowly but surely allowing our assets to mature. We think that there's going to be better value in the future than is currently shown in the markets. That's our carry rate. And then I think just to round things off and recap, a 100 basis point decrease in rates, 15.5%. That's our all bond curve. If we get 50, you're going to get 12.5. That's just the maths. Thank you.
The second half of today, a little bit shorter. We're going to continue with multi-asset funds. And this is the fun part where you can test asset allocation views with some of the fund managers. We're going to look at SA Multi-Asset High Equity as well as SA Multi-Asset Flex. But our first speaker, Rory Spannenberg from Vunani Fund Managers. Rory, thank you so much for joining us here this afternoon. Rory is going to focus specifically on global multi-asset flexible. Rory, thank you so much.
Thank you, Eugene. I think bonus CPD points for everyone who made it back after the tea break. Thank you very much for your interest and your attendance. Shortly after being elected as the UK Prime Minister, Harold Macmillan was asked by a journalist what he anticipated his biggest challenge in government would be, to which he responded, events, dear boy, events. And if we cast back and look at the anatomy of the global equity market over the last 25 years, it's certainly been quite eventful. Most of these events, and there are many in between, will be quite familiar to all of you. And despite the slightly grandiose title, I think the lesson here, first and foremost, is one of humility. There are any number of things that you simply cannot predict or anticipate or forecast, and to the extent that you can identify a valuation bubble in the early 2000s or a credit bubble in 2008, very often the timing mismatch between recognizing it and the market finally coming to terms with it, and ultimately a straw that breaks the camel's back to reveal that embedded risk is something that most investors don't get right. So as a stock picker, one also recognizes that if you're getting a little over 5 out of 10 of your stock selections correct, you're actually doing very well by global standards. And as a result, one should harness some humility, diversify, plan for things that will inevitably go wrong. And from a macro perspective, other than the humility, I think one of the biggest learnings, certainly for me, has been that identifying good companies to invest in is really only 50% of the job. The art and or science in portfolio management is really about constructing portfolios of uncorrelated positions that diversify one's risk. Appropriate position sizing and the calibration of risk is really the true skill in portfolio management. I realized after I submitted this slide that I could have and should have gone back to 1998 when I gave up bartending and being a construction worker in London and bought a suit and got a job at Merrill Lynch. 4 months later, in fact, 17th of August 1998, Russia defaulted on its debt, and the emerging market bond team, all 450 people who populated a massive floor in the center of London, were all retrenched within 1 day. Only later did I learn that the top traders in that team, about 12 months earlier, had all been given a BMW Z3 as part of their annual bonus. I had slightly less sympathy for them, but it was really a defining experience, as each one of these episodes has been. There's something that you learn. And I think risk management is certainly at the forefront of everything we do. The fund we're talking about today is a global flexible fund. And with that in mind, downside protection is very much at the forefront of our thinking. So I'm going to flip things around and take a few lessons from stock-specific investments that we've made over the course of my career. So in 2012, I actually switched my focus entirely to global equity. And the first stock and lesson really relates to an investment we made midway through 2016 in Blackstone. And the lesson here is really to start by looking where everyone else isn't. So Blackstone is a leading alternative asset manager today, and it certainly was in June 2016. When I was casting around for financial companies that met my definition of quality, that means that they should be good, efficient users of shareholder capital. They should benefit from some strategic competitive advantage, and the unit economics need to be very favorable. And Blackstone certainly met all those criteria. But at that stage, it was structured as a partnership. It was very complex. The tax treatment of the dividend was hard to understand. And the fact that because of the partnership structure, they weren't included in any major indices, or any indices for that matter, meant that it was very overlooked by institutional investors. There was almost no sell-side coverage. Yet here was the leading alternative asset manager, diversified by product group or product set capabilities. So they managed private equity, real estate, credit, fund of hedge funds, benefiting from exceptionally strong growth in alternative assets. I think we're all familiar now with the flood of money out of active public equity into alternatives on the one hand and passive on the other. Well, Blackstone has been a big beneficiary of that trend. Yet at the time, it was trading at less than 12 times distributable earnings. That is, earnings including realized performance fees. And so that certainly ticked a lot of the boxes that we were looking for. And management had communicated, I think, a very sensible strategy to reduce the pressure that the business faced from the realization cycle in private equity, which is typically a 7-year cycle, through lengthening the duration of their core products out to 20 years, but at the same time also raising perpetual capital. And today, Blackstone trades on 34 times distributable earnings. It's collapsed the partnership structure. It's been taken up into indices. Institutional investors have come on board and recognized the wonderful fundamentals that Blackstone has benefited from. So lesson number one, start by looking where others aren't. And over the 9-year effective holding period, Blackstone's delivered just shy of 1,000% total return in US dollars, 16% above the average financial company tracked by MSCI. Lesson number two, exercise strategic patience. TransDigm is undoubtedly one of the highest quality industrial companies we follow. It's a manufacturer of aircraft parts. The barriers to entry in this industry are exceptionally high. Really, the regulatory requirements and also the requirements from OEMs such as Boeing and Airbus are very stringent. And so it takes a long time to get the certification and then to be adopted by one of the manufacturers. They have in excess of 20,000 registered patents, or they have registered in excess of 20,000 patents. Over 6,000 of them are active today. And 80% of TransDigm's revenue is generated from products that they are the sole provider of. And so you have the benefit of extremely long product life cycles, because the average aircraft lifespan or the aircraft platform has up to a 50-year lifespan, where you are able to sell parts as part of the servicing of those aircrafts at very, very high margins. In fact, EBITDA margins are in excess of 50%. So this is a stock that is almost never cheap. And in the midst of the COVID pandemic, share price fell from over $600 to below $300. When we started accumulating, I think the average price was closer to 320. And it was the first time since we'd been following it that it traded at a discount to its long-run average EV/EBIT multiple, balance sheet neutral PE. So buying it at the right price, even the highest quality businesses, makes a big difference ultimately in your return. TransDigm's returned close to 500% over the 5-year effective holding period, 18% higher than the average industrial company. Patterns and proxies abound. A lot of the investment game is really about recognizing things that you may have seen elsewhere. Through our investment in Blackstone, we were very familiar with what is widely considered the most successful private equity transaction of all time. Blackstone delisted Hilton Hotels and separated the real estate business, the assets, and the hotel operating company, and then relisted that as an asset-light operator and franchisee of hotels. And other hotel companies followed. We were shareholders in Marriott. They bought Starwood and adopted the same playbook, sold the underlying hotels, and returned capital to shareholders. And so if you think about it, hotels are typically cyclical businesses. They are exposed to the consumer discretionary cycle. And if you are an owner of the underlying hotels and the physical properties and you employ all the staff, you have a lot of operating leverage. To the extent that you convert your revenue line into a fee-based or royalty-based revenue line, you do away with a lot of the cyclicality because the costs don't reside with you. And Accor is a French hotel company adopting a similar playbook. Since they made that decision, I think, I can't read the small print here, but it's probably 2019, they've returned almost 80% of operating free cash flow to shareholders as opposed to 34% prior. So this has been a bumpier ride, a bit more volatile, but we were able to buy it at a 40% discount to other branded hotel companies. And over that time, it's delivered just shy of 100% in US dollars, 6% above the average consumer discretionary company. So use the experience you've had with other companies or investment cases you've seen play out elsewhere and apply them to new investments. So I mentioned a hit rate of 5 out of 10. It would be remiss of me not to include examples of mistakes we've made. ASML might be familiar to you as a company with a monopoly in lithography. But despite that monopoly, they are still very reliant on having functional underlying clients. In this case, the client base is very narrow, and ASML has benefited from a very robust backdrop for semiconductor makers. But it's an incredibly diverse universe. So while we read a lot about AI and NVIDIA and the demand for chips for cloud-based processing, ASML is also exposed to other chip manufacturers, notably Intel and Samsung, that still manufacture some of the old cart horses of the semiconductor world that go into smartphones and the like, where demand hasn't been quite as robust. And so what you see there is very strong initial returns. The book-to-bill ratio, in other words, orders to revenue of 1.5%, 1.4%, that's dropped quite significantly. And that's as a result of two things. Challenges faced by underlying clients, but also geopolitics. The Biden administration banning the sale of their very high-end equipment to China meant that they were delivering on orders faster than they were taking orders in. So that book-to-bill ratio dropped to below 1 times, and the rating of the share was affected. Pleased to say that while we've been on the road, because we were presenting in PE in Durban last week, it's rallied about 20% off its lows. And we think the strong fundamentals ultimately will prevail, but it is very dependent on functionality of its underlying clients. And then the last example is Novo Nordisk. Relative market share, even in a duopoly, is very important. I can also use the example of Boeing and Airbus. Market share is roughly 50-50. One doesn't necessarily have pricing advantage over the other. Airbus has not been able to capitalize on Boeing's poor safety record because of very long delivery lead times, and also customers are very price sensitive. In the case of Novo Nordisk, they are the leading manufacturer of diabetes drugs, but in a very competitive market with Eli Lilly. Yeah, initially, Novo Nordisk did very, very well, where they were delivering on a strong product pipeline. But because of shortages in the inability to meet demand, because of supply shortages, meant that the advantage that they had in terms of their order book, Eli Lilly has caught up and overtaken them. And hardly a day goes by, including last night, there was a trial that a result that came out that was favorable to Eli Lilly. The market is very focused on relative market share. The underlying story here remains incredibly robust. The World Health Organization in 2022 estimated that there were 1 billion people who were clinically obese, yet only 2% of the population is actually receiving treatment. Yet global healthcare systems are inundated with comorbidities from obesity. In other words, we treat cardiovascular issues and the like, but not the underlying issue, which is really the obesity crisis. And as that penetration rate or the treatment rate increases, the total addressable market, we think, will be more than sufficient for both Eli Lilly and Novo Nordisk to benefit handsomely. Right, so those are the key lessons. That translates into our product. This is the Global Flexible Equity GIPS Composite Group, of which the Vunani BCI fund, which I'm representing today, is a part of. I took over the management of that fund in April 2022. Substantially outperformed its composite benchmark, which has a very high equity weighting, as well as the Global Multi-Asset Flexible Peer Group. The fund has a slightly less attractive track record relative to the composite benchmark. It really has to do with the more recent launch date. Remember, the escape velocity from COVID was exceptionally strong, liquidity-driven market, and a fund with downside protection in mind is likely and will and has underperformed in rising bull markets, because we tend to play defense very well and make up all that underperformance on the downside. I'm pleased to say, however, that we've narrowed the gap to the benchmark and widened the gap to the peer group. Thank you very much.
Any questions for Rory? Rory, we can definitely see improvement in the fund since you took over the fund, and I mean, you've got a phenomenal track record as well. I just want to test your views on the US, because we heard a couple of views in the US, and especially with some quality managers sticking to US only. But we're slowly but surely seeing a migration of assets away, or people disinvesting from the US and looking at other developed markets like the UK, like Europe. Your geographical positioning of your fund at the moment?
Yeah, we've been underweight the US for the best part of the last 3.5 years. But I mean, it is by some way our largest absolute position. More than 60% of the fund is invested in the US. But valuation, we think, is challenging. Market benchmarks also extremely concentrated. And so my view is that there's quite a lot of risk embedded in the benchmark, and the US is probably at the forefront of that issue. We are overweight the MSCI World in Europe and in the UK, so probably a skew more towards value-driven markets. But that equally in Japan and in Asia ex-Japan, where we find very good value.
But I mean, yen in Japan can also be an additional benefactor or benefit for exposure there, because I mean, the yen is very much undervalued. Just quickly, in terms of asset allocation, you've got a fairly healthy exposure to bonds. I would assume that is US Treasuries. We've heard one or two controversial comments as well on US bonds, fears of inflation maybe not being as under control as they would hope for. And some of the comments that Jerome Powell also made in terms of US inflation and when they're going to reach their target. Your views on US bonds, can that potentially hold risk for investors as well?
So we are quite equity-centric, despite the fact that I'm on a multi-asset panel here. We tend to fill the portfolio bottom up with strong equity ideas, and to the extent that we don't find value, we're happy to sit on the sidelines. So the composite benchmark is 80% in equities, the balance is in US T-bills. Today we are overweight T-bills and underweight equities. In April, early April, we went overweight equities, and so we responded, I think, to that, the pullback in global markets, and we've reverted to a more defensive stance now. Measured bottom up, our proprietary intrinsic value discount of our global buy list is mid-single digits. And so that's not very attractive. We're buying 3-month T-bills at 4% today, probably slightly less. And so to me, that's just a reasonable place to park cash when you are not constructive on equity risk.
Until you can redeploy on that, it's not too much to read into US bonds. Rory, thank you so much for being here this afternoon. Really appreciate it. Thank you.
Thank you very much.
Right. Next on multi-asset, they run a couple of portfolios and funds, specifically in multi-asset high and multi-asset flexible categories. Catherine from Granite Asset Management. Catherine, thank you so much for joining us.
Great. So my name is Catherine Blursch. I'm part of the investment team at Granite Asset Management. And I must just apologize in advance that I've been fighting off a cold this week. So if I sound a bit blocked up and like I smoke 10 packs a day, that's not normal. So just bear with me. And that's why I've got my trusty glass of water like the other speakers did. I learned from their mistakes. So Granite exists to protect and grow the savings that our clients entrust to us. That's a really simple idea, but it's something that we take very seriously. We've been around for about 10 years. We've presented at quite a few of these kinds of events, and we try to talk a little bit about why we do what we do, how we do it, and what we do. And we've spoken over the years about our investment philosophy and process, and obviously that's very important. It's kind of our guiding light, and it's the thing we focus the most on because we think it's what leads to that objective of protecting and growing our clients' savings. But it can sound a little bit theoretical to someone who's not part of the business. So today we thought, to paraphrase Monty Python, we'll try something completely different. And I hope it's going to be interesting for you. So we get a lot of questions from people that are interested in investing in our funds. And one of the questions that we get very often, particularly from advisors like yourselves, is how we think about alignment in our business. And we think that is a very good question, because in an asset manager, you often have different and competing interests between the stakeholders in the business. So there are obviously 3 groups of, you could think of an asset manager as having 3 groups of stakeholders. Who do you have? Well, first of all, you have the people that work in the business, the employees, who are actually there to do the work. Then you have the owners of the business, the shareholders, who provide the capital for the business to function. And then most importantly, you have the clients or investors who provide the savings for the asset manager to manage. But the challenge is that those 3 groups can have very different ideas about what they want. So what do each of them want? Well, employees, they want to be paid as much as possible, right? So they want to be earning nice salaries and nice bonuses. But the challenge is that an employee's being paid as much as possible means that the profits are reduced for the owners of the business, so they don't like that. What do owners want? Well, they want to pay employees as little as possible so that they can maximize their profits. And the easiest way for both of those groups to be happy is to take advantage of their clients by charging high fees or by focusing on growing the pie, right? By just gathering assets rather than focusing on delivering the best possible returns for their clients. And then what do clients want? Well, clients want to pay the lowest fee possible and get the best possible returns. But that's only really possible if they can pay a reasonable fee, but they also have a competent, well-incentivized asset manager who's focusing on delivering the best possible returns for them instead of fighting over the spoils. So when these three groups are behaving like dogs fighting over a toy, there can only be one winner and two losers. And it's for this reason that we can totally understand why alignment is so important for you when you're deciding whether an asset manager is someone who should be managing money for you or your clients. But it doesn't have to be this way. What happens when these three groups come together and overlap? We think that that's where you start to get alignment. And in an asset manager, that can happen in two key areas. The first is that the employees and the owners of the business should be investors. So everyone at Granite, we call them Granatians, is an investor in our funds, and they pay full retail fees. And we're happy to do that because we've very specifically chosen quite a narrow product set of funds that we think are all good products in their own right. And secondly, because we're committed to maximizing the odds of delivering the kind of returns that our clients would expect from us. And I can tell you from my personal experience that being invested alongside clients means that we feel the joy and the pain very, very closely when markets go up and down, and it's tough. The second area is that employees in the business should be owners. And at Granite, everybody who's an employee of Granite is at some point invited to be a shareholder. And that's not in the form of phantom shares or bonuses or anything like that. It's real equity in the business that's bought with cash or a loan. And I can speak for myself when I say being an employee who's also an owner really changes the way that you think about the business. You feel like you're part of building something rather than just earning a paycheck every year. And when employees think like owners, they can start to make good decisions. So they start being able to make sacrifices for their own short-term gain for the long-term best interests of the business. They're happy for those profits to be reinvested, so for example, in hiring good people, because they know that that's going to build a better business for the long term. And one example I can give of this was, so I started at Granite in the beginning of 2020, which was just before we launched our multi-asset funds. Those funds were seeded with money from individuals in the business as well as their friends and family, and we launched them on the 1st of February 2020. And I can tell you that nothing focuses your mind quite like having the money of your friends and family entrusted to you. And then what happened? Well, COVID hit. And you can imagine that it was a pretty scary experience for all of us to see that drawdown during COVID, knowing that our own savings and the savings of people that we love were invested with us. But because we have this alignment in the business, we could double down, work hard, pull together, work very hard as a team to protect that trust that had been placed in us. So when these stakeholders overlap, you start to move from this kind of win-lose scenario into more of a win-win situation, because you're pulling in the same direction. So we come to work every day focused on protecting and growing the savings that are entrusted to us, because we know that if we do that to the best of our ability, then the returns will follow for everybody in the business, for our clients, the shareholders, and employees. And we're happy, like I said, to reinvest to the benefit of our clients. And that's part of the reason that you might have seen we've added a few new faces to our client and investment team over the last few months. So when you have alignment, everybody wins. And what's interesting is that the same thing applies for when we are looking at companies to invest in our funds. So the exact same reason that alignment is important for you when you're considering an asset manager is the same reason that alignment is very important when we're looking at whether a business is a good idea to invest in or not. So when you have a management team in a business that has a meaningful portion of their wealth tied up in shares of that business, they start to think like owners. And what does that mean? It means that instead of trying to maximize short-term profits by either screwing their clients by charging higher prices or lowering the quality of what they offer, or by taking advantage of their employees, they're instead happy to reinvest for the benefit of their clients and invest in the business for the long term. They're thinking decades out and leaving a legacy rather than how do I maximize my bonus today. And the reason they do that is that they know that having happy, satisfied customers is much more likely to create a sustainably profitable business that grows and sustains for the long term. So alignment really matters here. So one example in our funds, which has grown to be one of the larger positions in our multi-asset funds, is an American company called Interactive Brokers, which is an online brokerage. And what they do is they provide a platform that enables anybody, individual investors or companies like hedge funds or active traders, to trade in a broad array of assets, from equities to bonds, options, futures, derivatives, on a global basis from a single account. So they basically offer institutional grade tools to anybody at a very low price. And so if we think of this business in the context of alignment, which I'm talking about today, the founder, Thomas Petterfee, still owns a controlling stake in the business. He's retired as the CEO, but he's still actively involved as the chairman. And his long involvement has influenced the business in two very key ways that have been part of their success. The first is that they've continuously taken their profits and reinvested these to the benefit of the client. And what that means is they've added new tools, new products, they've invested in making the platform better and more powerful, and also in lowering fees. And what that means is that they now can offer clients the best tools available at the lowest cost in the market by quite a long way. But they've also earned 60% net profit margins. And how have they done that? Is that over that whole period, they've also reinvested in automation and efficiency. So trying to do things as efficiently as possible within their own business, long before those were buzzwords like they are today. And what that means is that you now end up with a business where clients are really happy because they're getting something great at a very low cost. And because they're reinvesting for growth, they're growing new accounts at 30% a year. They only have about 4 million customers, so there's a long runway for growth. And that means that shareholders get very healthy double-digit returns. So everybody wins. And we've recently been hunting for more of these kinds of opportunities where there's still founders that are actively involved in a business. And the more we look at those kinds of businesses, the more we can really see the benefit of a properly aligned management team to reinvest and build the kind of businesses that are sustainable and endure over the long term. So I'm going to wrap up in saying that alignment of interests is something that matters to us. It's a very simple idea, but it's something we take extremely seriously. Thanks.
And I can echo that. I mean, we can see the alignment in your business with your clients as well, and how you've grown the team over the past couple of years and attracting a lot of talent into your investment pool. You've also expanded on the fixed income side very recently. For those of you who want to know who that is, you can speak to Catherine or Raina. They're both here. Very quickly, Catherine, just from my side, your investment process is very interesting, very different to a lot of typical fund managers. You don't start with a strategic asset allocation and then TA overlay. We've heard the story before. We know how it works. You look for securities that can add value relative to each other into the portfolio. Some of your allocations that worked very well for you, SA property that found the way into the portfolios, I think very different to a lot of typical multi-asset high equity or multi-asset flex funds. You also had a healthy component to global property. Maybe just quickly a quick update on the property components. Like I said, I know SA property worked exceptionally well for you. Did you take profits, and how did those securities find way into the portfolios?
Yeah, so to answer your first question, I think on the property side, as much as there'd been a bit of a rally and a run and it did do well for us, we still think there's a lot of value in property. Companies that are still trading at a big discount to their net asset value, very attractive dividend yields, and those are on assets that are heavily written down, and it really looks like both in South Africa and in some of the other areas that we've invested in property, it looks like the market's starting to turn positively. And how we go about looking for those opportunities, I think, is probably a good example of our process, is that we don't say, oh, property looks great, and we just go buy anything. We have a very strict qualitative process. My colleague Ty is the property guru, and he has literally looked at every property company that there is, and almost every one of them has found something about it that we don't like. It's often a governance or management question. Often management teams are not material shareholders and are not aligned, and have related party transactions. They do deals with the business. They issue shares so that they can sell properties into the company and do all of those kinds of things that actually act against the best interest of shareholders. So we try to rule those ones out, and the ones that have been reckless with their balance sheets. And from that, we found just a handful of names that own really good quality assets in South Africa and London and Europe that are trading at very, very big discounts. And those are the few we still own.
Fantastic. Any other questions for Catherine? Catherine, thank you so much for being here this afternoon. Always grateful for your time. Thank you. Coming to stage now, Mark Seymour from North Star Asset Management. Mark, thank you so much for your time this afternoon. The floor is yours.
Okay, great. Two topics I'm going to discuss today, which are of current interest. One, political interference and what's happening currently at the Fed. And secondly, the evaluations and comparing the current dynamics around AI and the dot-com bubble. And so we look at these two topics as to potential risks that we are currently thinking about, apart from all the other dynamics that we are thinking about. Okay. Let me make sure I understand how these slides work. Okay, so navigating uncertainty. Obviously, it's a complex world. Some wise words of wisdom from famous people that we know. Warren Buffett. Forecasts tell you a great deal about the forecaster, but they tell you nothing about the future. I think it's a strong reminder that basically highlights, in terms of being able to navigate uncertainty, the idea is not making a wild forecast, but rather to apply oneself through in-depth research and understanding to kind of give you the highest probability of getting to an outcome. Another famous words, those who cannot remember the past are condemned to repeat it. Once again, lessons from the past as a function of human behavior. Often at any point in time, the narrative tempts one into believing that this time it's different. We can learn from these mistakes by looking at the past. Next one, a quote by Howard Marks. We may never know where we're going, but we'd better have a good idea about where we are. And that's also extremely true in terms of investing, making sure that when you are buying an asset, that you're paying an appropriate price. So you need to understand the current valuation. So certainly some wide words of wisdom. Okay, so getting onto the topic of political interference and big personalities. I've got a little video clip.
Game. This is what they wrote. The consequences of Trump taking over the Fed are hard to predict, but history is not encouraging. In 1970, Richard Nixon, who wanted a rate cut to juice the economy ahead of his 1972 re-election campaign, tapped Arthur Burns, one of his top economic aides, as Fed chair. Under Burns, the Fed delivered. That move is now widely seen as contributing to the double-digit inflation spike that roiled the country during the 70s and ended only after a new Fed chair came in and raised interest rates enough to trigger a recession.
We have a real terrible head of the Fed. And if he brought down interest, in Europe, the European Union, they've lowered their interest rate now 11 times. And we haven't lowered ours at all. He's a stiff. He's a knucklehead. At a certain point, it didn't matter anymore because the guy is just not a smart person. Shouldn't have been there. I think they extended him because they knew how much I couldn't stand him.
You disagreed over the cost of construction at the Federal Reserve.
It looks like it's about $3.1 billion. It went up a little bit, or a lot. So the 2.7 is now 3.1.
I'm not aware of that.
Yeah, it just came out.
I haven't heard that from anybody at the Fed. You're including the Martin renovation. You just added entire capital. Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago.
I think we're underappreciating how fragile things are.
The global financial crisis, that was 2008, 2009. I can't tell you how many economists said that could never happen. It happened in the Great Depression, never going to happen again. Winding up to today, that the U.S. can never run into problems with its debt, because that never happens, but it did. It doesn't mean we know what's going to happen looking at history, but I think if you don't look at history, you forget what could happen.
Wow, the system is shakier than it looks. I don't know. Am I right about that, sir? Am I wrong about that? What say you?
Okay, so the point here is that at this point in time we have Trump, and as we know, he's seeking to influence the Fed. Back in the 70s, the same dynamic unfolded. It's the only time in modern history where the presidents have tangibly tried to influence the Fed. And the consequences are something that we need to take into account. Okay, let's have a look. Okay, so the next point of discussion is to compare the dot-com bubble to what's currently happening. We know that during the dot-com bubble, a number of businesses came into existence as a changing technology afforded companies extraordinary ability to offer new services to clients. However, a lot of those businesses were unsustainable. Great ideas, whether they could be translated into revenues and whether they could be translated into profits was another story. The bottom line is that during that period in time, it was quite a perilous time, uncertain time for investors as to which companies to invest in. So there was a lot of failures, but if you managed to pick the winners, then the environment was equally as perilous. I've got some charts here of some of the comparing the earnings and the prices for some of these companies. And if we have a look at some of these survivors, we know that the likes of Amazon has delivered fantastic earnings over time. I've got the chart going here from 2001 until present. I'll look at the earnings per share for each of these companies going all the way back from the early 90s until the present day, just to give one a sense of the profile of the earnings. So we know Amazon is one of those. Another one, Cisco, fantastic earnings growth in the early years, and those returns slowly diminished over time. We've got Microsoft, a fantastic winner, strong earnings growth, tapered off slightly, and then has reinvented itself in more recent times. Intel, fantastic earnings growth at the start, but as we know, more recently, the fault of paying out dividends are not, or at least buying back shares and not reinvesting as vigorously as competitors, has kind of put itself into a tight spot, and has more recently received a sort of equity injection from the government. Qualcomm, another strong performer in terms of earnings, a little more cyclical, but certainly the same profile, very strong at the start and tapering off towards the end. And then the likes of Oracle, which has also been in the news more recently. And then how's that translated into returns? Now, we all have heard the stories about the fantastic returns and, the perils of, buying in late. But I'll demonstrate this in terms of the price returns that we've seen from some of those companies. Amazon at the start, when it listed, over the very short period before the dot-com bubble, you've got 300-odd% annualized returns over a short space of time. Absolutely spectacular. At the top of the market, however, it had a 90% drop, and then has subsequently performed very well. It's one of the few, it was the only company that you could have actually bought at the top and still actually got fantastic returns in the order of 18-odd% price returns. The next one, Cisco, also fantastic, sort of 80-odd% annualized returns, but then subsequently almost nothing, despite having generated earnings pretty decent over the full period. Cisco, same story, at least the Microsoft, 50-odd% returns, and then subsequently it wait a good 10, 15 years to get to break even after the dot-com bubble, and then in more recent times, fantastic steady earnings growth, and you've generated good returns. Same story, Intel, 50-odd% returns, but since then, absolutely nothing. Qualcomm, similar, 80-odd% returns, fantastic explosive returns as you came into the year 2000. However, since then, very mediocre returns, certainly in recent times as valuations have become a lot more favorable, have you generated decent returns there. And then the story there, here, Oracle, 70-odd% returns, same story, sort of 10 years of moving sideways. And then more recently, it's also been able to adapt to the AI dynamic. And as we know that even just over the last week, the share price has jumped 30-odd%. So certainly interesting in terms of how, for the investors and the uncertainties that are unfolding, things to think about. And this just demonstrates that, yes, fantastic returns can be generated, but you need to be paying the right price. And you need to be realistic about the price that you're paying for the earnings that are potentially there. Okay, so just consolidating that information, the initial part of the dot-com boom, if we look at those companies that I've just spoken about, the survivors, if you manage to purchase those shares, the earnings growth is quite phenomenal. So I want to try and contrast that dynamic to what's happening now, and to see if there are any parallels or any lessons that we can learn. During that period, the earnings growth out of those companies that I mentioned was like 65% per annum. I mean, it's absolutely extraordinary. And with that, you can see the red line is the actual price appreciation. So at the start of the period, those companies, for the most part, traded on a 50 multiple PE. And then as time went on, you had extraordinary price appreciation, or 40 PE, sorry. And then when you got to the 2 years before the actual turnover, the sell-off in 1998, more or less, the share price was just absolutely parabolic. You went from a 40 PE all the way to 120 PE. So it was during that period that, the market mania kind of really set in. But for the most part, as an investor, buying stocks on a 40 trailing PE with very, very strong earnings growth is very responsible. It only became really irresponsible in that last 2-year period. So how does that compare to current dynamics? So if we have, there's a broad range of companies that are involved in artificial intelligence, the likes of Meta, Adobe, Microsoft, Google, Amazon, Oracle. They've all performed, slightly differently. So just talking about these sort of companies that operate in the cloud and infrastructure and platform space. The dynamic that's been unfolding there on average is earnings growth of around about 30%. So roughly half of the earnings growth at the companies that I've just mentioned earlier in the dot-com bubble. So the earnings growth hasn't been as explosive, but it's been pretty steady and pretty good. And, lower for some, higher for others, but on average. Interestingly enough, the share prices have also kind of tracked earnings. In actual fact, there's actually been a derating for some of those companies. So if you take an average, the PE ratio has actually come down from 70 down to 32. So putting that into kind of a little box, a 30 PE for companies growing at their earnings at roughly 30. We're not in that same euphoric space that kind of precipitated the dot-com rollover. I think it's an important point to make there. Although if you look at certain companies like Oracle, we know that was recently trading on a PE of 50, that's now suddenly jumped up to 70 odd. So, there are signs potentially of some mania starting to unfold. And then if we have a look at the likes of NVIDIA, Broadcom, TSMC, and ASML, similar story there, earnings growth of 50%. So really, really strong earnings, but not quite the 65 that we saw in the dot-com bubble. And a similar story here, PE ratios roughly 50. And if you look at on average across those companies, they're still at 50. So still no signs of that euphoria that we saw in the dot-com bubble. And the reason why I mention that in the context of the political interference is one of the risks that we see is that, in the event of Trump potentially getting his way and there are potentially extraordinary interest rate cuts, the one thing that wouldn't surprise us too much is if there's that air of mania that still may precipitate within the space. If we take a step back, this is an interesting chart. That blue shaded area represents the earnings for the S&P. So this is going back 100 years now. So just kind of really stepping back and trying to get a sense of where we are currently. The bottom end of that shaded area represents 11 PE, and the top represents about a 22 PE. So the reason why I chose that band is because the market 60% of the time has operated in that space. And arguably, 20% of the time it's been expensive, so above that shaded area, and 20% below that area. And what should be quite strikingly interesting by looking at this chart is that during the dot-com bubble, the yellow line was way above the 22 PE, and it kind of mimics of where we are now. So at an index level, we would argue that the market is extremely expensive. And there may be reasons for that. Maybe it's a lower inflation environment, although that's not true as we see inflation becoming a problem. So certainly that's another red flag for us. So political interference and the very entity that's designed to provide stability, red flag. Valuations, by this measure, look very extreme. But if you look at the actual, the dynamics in AI, there's no sign of that strange euphoria. So these are just some of the things that are dominating our thoughts currently and probably worth keeping in mind. And then I'm not going to go into too much of a conclusion there. I see I have run out of time. Sorry, Eugene. The take-home point here is that we apply all this thinking, this tackling uncertainty, built up a lovely track record here. We've got the North Star Global Flexible Fund, so talking to multi-asset product, has outperformed peers by more than 2%, so closer to 3%. A nice long track record for a South African manager managing global assets. So we think we're applying the right thinking, the rigorous work that's required to outperform. And if you have any questions, please chat to my colleague, Mike Clare, for any further input.
Mark, thank you very much. The proof is in the pudding, so the process is clearly working. I mean, you should have started with that slide. I don't know if any questions from my side. I just want to check with the audience. You really want to get to lunch now, don't you? Right. Question, yeah, sorry.
Well, we've been very fortunate enough to have gone through a number of iterations in terms of building asset management teams. So myself and a couple of my colleagues go back to the late 1990s. Strange to even put it into words. Myself coming into the market during the dot-com boom. And then gone through a number of iterations in terms of building asset management companies. And I think the previous speaker spoke to some very important points there. So shareholding, being an investor, and being an employee in the business, and understanding what is required to create a stable environment and create returns. So yeah, I mean, so just getting those team dynamics right has really been the key. And then the other one is, in this new age, access to information. It's not like it was 30 years ago where you would have had to go on and got physical copies of annual reports, etc. This information is available. It's just a matter of knowing where to apply your efforts so that you tackle the relevant issues that point to accurate valuations, and then applying that in a rigorous, repeatable fashion. As it's pleasing that it's producing the results.
I don't know if anybody could hear that the actual question. If that was the answer, what is the question? What makes you one of the top funds? Right. Mark, thank you very much. Right, next from Vigio Fund Management, Filelo Machekane. Filelo, thank you so much for joining us this afternoon. Always grateful for your time. Thank you.
Thank you very much, Eugene. Good afternoon, everyone. Thank you very much for your time today to come out and listen to our stories. I'll try to keep it brief. I think it's just myself and another speaker who are standing between yourselves and lunch. My topic for today is diversification for resilience and positioning for opportunities. The reason why this is so topical is that earlier on in the morning, you heard from the equity managers talking the story about equities, then you heard from the fixed income managers as well. At any given point in time, those strategies have a place in client portfolios. What we do as a multi-asset manager in this particular product is that we do that work for you. We'll look at the dynamic overall in the market and say this is the right time to be overweight equities, or this is the right time to be overweight fixed income. Who are we? We were founded in 2003 by a gentleman by the name of Patrice Moyal, and we are founded as a hedge fund manager. And over the years, we've developed various products, including long equities. We continue with the hedge funds. We've got Pan-Africa exposure. And in addition to that, we've got the multi-asset that I just spoke to. So I joined in September 2010. It's actually just, call it just under 15 years now. I think I joined on the 28th of September 2010. And it was to run the Pan-Africa funds. And those have done reasonably well. I think you've heard from the previous speaker talking about the opportunities that they see in the rest of the continent. We hold the same view, and we've got our ears to the ground in that segment. What's the market outlook? The previous speakers, particularly on the equity side, they spoke about the opportunities that they see in South Africa versus the rest of the world. We are no different. equities are basically a geared play on what the economy does. If the economy is doing poorly, equities in aggregate will do poorly. This chart here shows expected GDP growth numbers for the world, segmented by different countries, and then by geographies, your EM and your G7 economies. What you can clearly see from all of them here is that they're all expected to actually show lower growth over 2026 to 2030 compared to the previous 10 years. If you look at China, previous 10 years, it was 6.8% growth. Then looking forward, 26 to 30, 3.9%. The same with India, lower growth going forward. US, lower growth going forward. The exception here is South Africa. We've been a low growth economy, but our expectation is that, as per the World Bank, is that growth is actually going to accelerate from what we've seen. I think the latest numbers, we're expecting about 1% growth for this year and jumping to 1.6% in the periods that follow. So there's an exception to the rest of the world. Then this slide covers the same thing. We're looking for a revision in growth upwards versus the rest of the world. Inflation, it's a similar picture. However, it's mainly the emerging markets where you've got inflation coming down. China, India, you've got South Africa there, and the region as a whole of emerging markets, inflation is coming down. Rest of the world, developed world, you've got inflation going up. I think the fixed income speakers before me, they spoke about how the US inflation is remaining sticky at the plus 3% level. That's a similar level to what we're experiencing here in South Africa, which is quite an anomaly. So when it comes to equities, I've said our growth is expected to accelerate from where we are. But that's not discounted in our valuations at present, right? We're still trading below the averages that we've seen over the past 10 years. And our view is that there is limited downside at the present level from getting involved in the equity space. The US, on the other hand, speaker before me, is looking a little bit frothy. There may be some reasons, but in aggregate, it's looking frothy. It's trading well above its 10-year average. So for SA equities, this compared to the fixed income space, we believe equities are cheap enough in absolute terms versus their own history, and they are now cheap enough versus the fixed income space. So as a result, we think it's a great opportunity to start getting involved in that space, and that's what we're expressing in our fund. So we're basically doing it for our investors. We're not saying, because this can change very quickly as well, where the dynamic changes, and we will say you might have to start getting involved in fixed income again, should that picture change materially. What investment opportunities are we seeing? I mean, I spoke about this earlier on. So we'll give you exposure to domestic equities, we'll give you exposure to domestic bonds, and property and cash as well. Versus the benchmark, that allocation that you saw in the previous slide has far outperformed the CPI plus 5, which is the target benchmark for the fund. What are we doing? Currently, we are underweight equities, but we are constructive equities. So we are upweighting because we believe that valuations are attractive, but the environment is quite volatile. We are using this volatility to actually pick up interesting names at attractive prices. On the property side, we like property. The market has turned there. Their balance sheets have been repaired. These are the property companies. The balance sheets have been repaired, and now for a change, it's starting to see great growth in yield, called call it mid-single digits. So we think that income underpin is quite positive for the sector. So we're running an overweight position there, and we have not changed it. On the fixed income side, we're pretty much in line with our strategic asset allocation, but we've increased our exposures to inflation-linked bonds, and we've shortened duration. And you'll see in the next slide the reasons for why we've increased exposure to ILBs. We're still overweight cash at the present moment, but we are deploying it selectively as opportunities come through as a result of pullbacks that we may see in the market. I think I'll skip quickly through the slide, but this basically just shows where we are positioned versus the strategic asset allocation. I mentioned we are underweight equities, 62.5% versus 65% in the strategic. We are overweight cash, 5.3%, and domestic bonds, we are neutral with property overweight. I spoke earlier on about our expectations. We've got 15% in equities. However, our process says because risk is elevated or volatility is elevated at current, the prudent thing may be to be underweight. And when prices drop, we'll pick up more of the equities. And as the environment normalizes a bit, then we might find us in overweight equities. So I mentioned overweight domestic property and slightly neutral on domestic bonds. I mentioned earlier on that we're buying some ILBs and the short end. And the reason for that, I think the fixed income speakers spoke to this earlier on. We believe our research tells us that historically, when inflation has bottomed, which we believe we have, looking forward for the next 12 months, ILBs have actually outperformed nominals. So we are tilting our portfolio to ILBs versus nominals, though we are remaining neutral on fixed income. On the equity space, I think I'll stress mainly what we're looking for. When we put a company into our funds, it has to meet the inclusion criteria, which stay in the middle. It has to have strong corporate governance, experienced management team, strong cash flows, and also solid balance sheets. We don't know for certain that the economic environment is going to turn next year, but should it not turn, these are the companies that are best placed to continue navigating the tough environment. I think I'll call out Momentum here. We got involved in Momentum in 2022. It was cheap, it was underperforming peers, and we could identify that there's some efficiencies that the new management team at that time could actually drive out of the business and put it on a better footing. Over that period, since we got involved, we've returned about 150%. More recently, we've gotten involved with All Mutual. It's been in the funds for now the past month and a half or so. And we believe that it is a similar picture, right? They've underperformed their peers, Sanlam, Momentum, Discovery. They've got a new management team as well at the present. And we are aligned that there are inefficiencies within the business, which they can unlock, and which will drive shareholder value creation. They announced their results last week, and they announced with the result a 3 billion rand share buyback because the stock is cheap, it's trading at about 7 times PE, and it's giving you an 8% dividend yield. So how we engage with these companies, because the environment has been tough, okay, we'll write letters to the management teams. Okay, this is what we're saying, this is what we believe the improvements you can make within your businesses, which should further drive shareholder value. So we started with Momentum 2022. These are the most recent ones with All Mutual, and we hope that we can replicate the success that we've had with Momentum. how has the fund done versus our peers? Over the past 3 years, so we've generated returns ahead of our peers, just in excess of 2 percentage points, with a 15.8% return versus peers at 13.1. On the equity side, we've seen an improvement. We're now collecting the second quartile, with the rest of the other funds in the first quartile. And having said that, in aggregate, our funds are ahead of our peers over the past few years. So these are just some of the awards that we've received over the past 2 years. And that's it from me. Thank you very much.
Hitler, thank you very much. And again, it's all in the numbers, especially your Actina fund, which is a multi-asset flex. I think it's worked well for a lot of client portfolios where clients don't want to make the asset allocation calls. You do it on their behalf. Very quick question. We often hear that, coming from a hedge fund background, some of that hedge fund thinking comes into long-only funds. Maybe just position that quickly. I mean, how does some of that thinking come into your portfolios?
I think capital preservation is quite key in managing hedge funds. And so how we've brought it into our long-onlys is that whenever we're engaging with a company, we look at what the downside is. Should we be wrong in our assessment and taking an investment in this company? What is the potential downside? So I mentioned Old Mutual earlier on. It's trading at a 7 PE. It's giving you an 8% yield. Should we be wrong in the stock, I'll say at minimum, maybe you get a little bit of a D rating, you're still earning a plus 5% return. So that's the downside protection that we'll look at. So we do this across the portfolio in the various names that we include in our funds.
Makes a lot of sense. Plelo, thank you very much. You are staying for lunch. If people want to engage with you, they're more than welcome.
Thank you very much. Again. And I think I made time this time.
Well done.
Thank you.
Right, for our last session today, it's my absolute privilege to welcome Andre Steyn from Steyn Capital. Andre is probably one of the top experts in hedge funds, being involved in hedge funds. Andre, I think since 2002, we've actually did a lot of short selling or involved in multi-billion-dollar hedge funds. So I do see as one of the big experts in our SA market. You've also won numerous accolades for hedge funds in Africa. So thank you so much for joining us this afternoon. It's a great privilege to have you here. Thank you.
Thanks very much for the invite. I really appreciate that. After a whole day of long onlys, it's nice that you've invited somebody who swings both ways, who can invest long and short. So thanks very much for that. Just briefly, because we don't have sort of airport billboards, we don't spend our clients' money on that. Just who Steyn Capital is. So we've been going for 17 years now. We have a team of 17 people managing just north of 17 billion rand. And our longest running fund has compounded just north of 17% annualized net of all fees. In addition to managing money in South Africa, we also very successfully manage money up north in Africa and also globally in frontier and emerging markets. And we have 3 portfolio managers managing the range. I'm very proud to say that in the Hedge News Africa Awards, which is sort of like the Oscars of the hedge fund industry, we've actually been either nominated or won an award in 11 out of the last 16 years since launch. So very proud of that. I think one of the nice things about the hedge fund is, we've heard from some of my long-only peers today here that there's lots of opportunity around. But the question is always, what have you wrong, right? And I think specifically in South Africa, South African equities are undeniably inexpensive. The previous presenter had an interesting graph there showing bond yields, basically declining, right? So bond strength, but SA Inc. equity is not doing well. And that's a clear disconnect, right? And I think that disconnect is there because of our own idiosyncratic risk in South Africa. And I think that really does mean that there is a place for a hedge fund, somewhere where you can benefit off that potential upside, but you've got some downside protection. It's also always very important to ask what a fund manager or a hedge fund manager is trying to accomplish with these funds, right? Because hedge funds can be a lot more different from each other than long-only funds. And so what we're trying to accomplish is we're trying to beat the market over time, but take on a lot less than 100% market risk. And very proud to say that we've been able to do that, significantly outperforming the market and with less volatility and more downside protection. And we do that by chipping off alpha on both sides of the portfolio, right? So we, as Eugene was kind enough to say, my first job in hedge funds was being a dedicated short selling analyst at a $10 billion hedge fund in New York. And, that still shines through in what we do in the short side. So this graph sort of shows that gray line, which is our long book, significantly outperforming the market. And that purple line at the bottom, which is the absolute performance of our short book, significantly underperforming the market. And that's exactly what you want, right? You want the shorts to underperform because that's how you're making money. And so I think that's, really shows the benefit of the hedge fund structure that you can, if you know what you're doing, make money on both sides of the portfolio. So just briefly, where are we seeing opportunity on the long side? I've mentioned SA equities, but then also I think the big thing is in emerging markets. And so our hedge funds do have direct exposure to emerging markets that we've brought in because of this view. And so this graph basically shows the performance of the emerging market index over the S&P 500. And if you look at this, you can see, number one, there's a clearly long-term cyclical relationship. There's times when emerging markets have soundly outperformed, and there's times when developed markets have outperformed. And you can see right now that we're actually on the longest stretch of underperformance in emerging markets relative to developed markets. So it's never possible to pick the bottom entirely, but you can certainly stick your head out the window and say, are we closer to the top or are we closer to the bottom? And I think this chart is quite insightful in that regard. And of course, we have seen year-to-date emerging markets start to outperform, the dollar start to weaken somewhat, and there's a very, very strong negative correlation between dollar strength and emerging market performance. A weak dollar means stronger emerging market equities. And of course, South Africa is an emerging market as well, right? We all talk about these outflows out of South African equities and sort of blame Jacob Zuma. But if you look at it, there's a lot of other emerging markets that have also seen significant outflows over the last 15 years. So it's only about 63% Zuma's fault, not entirely. Investors are also very under-allocated to emerging markets. So you see global investor allocation sitting around 5%, but emerging markets are 40% of global GDP. So this is something that we're very excited about on the long side. But then I do want to talk a little bit about the dark art of short selling, because it is important, something that hedge funds can do, long-only funds can't do. And just to talk about our approach to short selling, why we do it, and also a war story or two. So this is our short selling track record, and it's basically that blue line which shows that we've made about 32% on the short book, which doesn't sound wonderful, but remember, had we shorted the market, you would have lost 500%, since May 2009. And so we've been able to, if you think about it, we've purchased insurance that pays you money. If somebody else wasn't already using the name, I might have called it outsurance, but I won't. And I quite like our cartoon. Our books are balanced, 50% of our numbers are real, and 50% is made up. How do we short? So we don't do valuation shorts, right? Because if something is crazily valued and it doubles, it's just 2 times crazy, and your high school math would tell you that that is still just crazy. We look for catalysts. And so our favorite catalyst is applying forensic accounting analysis. So I'm a chartered accountant and a CFA charter holder. Many of my colleagues are as well. And so we utilize this forensic accounting analysis to look for companies that are misrepresenting their earnings quality. So, and I think that's quite important. And the psychology is very important, right? So this graph sort of shows the business cycle, times when it's easy to make money, and then also times when it's hard to make money. And all of us knows that's how the real world works. The problem is that the market expectation is normally this upwards and to the right line. And that creates a massive amount of pressure for management teams to manipulate financial results. And so what we often see is there's a hiccup, And the CEO and CFO look at each other and go, well, next quarter is going to be better, right? Because humans are hopeful creatures. And they stretch. They report closer to that line. They don't want to lose their jobs, their compensation, and the like. And the next accounting period, that economic weakness deteriorates further, and they got to make up the stretch. So these companies tend to miss earnings with great regularity, and we have a high success rate at being able to identify these businesses. It does work on the other side as well. There occasionally are companies that hold back a little bit of cookie jar, and so it's important to be able to recognize that as well. Some of the short selling use cases, alpha shorts, so making money, that's our primary use case. You can do a pair trade, although we tend not to do very much of that because oftentimes pairs are driven by sectoral things, and what you make on the one side, you might lose on the other. An exception might be going long ShopRite and short Woolies and Pick n Pay and Spar, which we have done. But that's more of a market share game. We might eliminate unwanted exposure. An example of that would be when Thungela got spun out of Anglos. We wanted to eliminate some of that coal risk, so we shorted Exaro against that just to reduce that exposure. We use it to implement arbitrage or obtain leverage. If you short something, you actually get the cash, and you can use that cash, either in a bank account for interest or to invest into something else. And I think really what short selling does is it really adds to your real diversification of your portfolio. Somebody mentioned earlier that if the economy turns south, your stock prices go down because corporate earnings might decline. Bond prices might also go down because people expect bond defaults to rise. Short selling bets against something. So it's real diversification, not just paper diversification. Okay, so this is an example of a short selling to implement an arbitrage. Fortress, listed real estate company, and at the time we went long one A share, one B share, and did it a few million times. But essentially, that means that you buy the entire business, if you work with an entire business's math, for 21.9 billion rand. But we then shorted out their holdings in Nepi, right? So we got that, effectively, that cash in. And so for an effective 5.9 billion rand, we bought over 14 billion rands worth of very high quality real estate. And then we got to work in an activist fashion to get them to repurchase those B shares using some of the Nepi shares. Maybe another nice war story is from when I was working in London. One of my biggest shorts was a Swiss company called Oerlikon. And so Oerlikon was a total mafia stock. You'll see that is the principal owner, the majority owner, Victor Vexelberg, and he's pictured next to that very nice gentleman on his side, which I don't know who that is. That's the CEO, and you can see there's nothing fake about that guy. But yeah, so it was just one of my biggest shorts, and it was a classic accounting short, right? You can see that these guys were capitalizing development costs to boost earnings, right? Their percentage of completion accounting, which is a very subjective portion of your accounting, they basically suddenly went from a 20% margin to a 50% margin, right? Interesting. And eventually, how it ended was that the stock was down 97%. It required emergency rights issuance. But before I got there, so I started shorting the stock there, and when it got to around there, that was pretty painful, right? And so I decided that I was going to don my best suit, which I typically don't wear suits, and I was going to confront this management team at their AGM in Zurich. And remember, this is a mafia stock, right? So I was already a bit apprehensive, but I arrive at the airport in the morning, and it's quite drafty, and I look down and I see I have a hole in my pants from there to there, and my underwear is hanging out. And so I arrive at the hotel, and it's a 5-star hotel, so naturally I know I can get a sewing kit. And I'm in the bathroom working with the sewing kit. And the sewing goes quite well, but ending is a bit of an issue. Couldn't quite figure out how to make a knot that's going to hold this thing. And so I walked out of the bathroom, and I could feel my pants disintegrating basically as I was walking. But I still had to confront these guys, a big public company in Zurich. They had TV cameras there. I was seated in the front, and when I asked my question, the chair asked me to stand up. So I knew everyone could see my underpants, but luckily, because these are Swiss people, they didn't say a word, didn't snicker or anything. And I was able to confront the company in that way. But that was I think just an interesting experience. But I welcome any questions you might have. Thank you very, very much for your interest.
Andre, thank you so much. And I mean, we've had a couple of hedge fund workshops I mentioned earlier as well. You've also been on there, or Stein Capital's always also been on there. So those of you who want to find out more about hedge funds, there's some recordings. We're continuing with the hedge fund workshops once a month. For exactly that reason, it's a great diversifier in client portfolios. But on that note, make sure you've got the right license category on your FSB1. If you're not sure, give me a call, or any of the BCI team a call, and we can assist with that. Andre, there's no questions from my side. I just want to check with the audience. Yep.
When you said you looked doubtful in companies were misrepresenting earnings quality, can you just give me an idea of what sort of metrics you look at?
Yeah, so I'm going to give a couple of practical examples. So there's 100 different ways, right? You're looking for people that are adjusting subjective things, either in their accounting policies, judgments, or estimates, which are used to calculate financial results. And capitalizing costs as opposed to expensing costs is one. Releasing provisions is another one. You might look at the cash flow statement, although that's not always. So Pick n Pay was a big short of ours last year, and actually their cash flow didn't look that bad because they were effectively using suppliers to fund their balance sheet. And if you do that, that's actually positive for your cash flow, but it means that your real debt is actually higher than what you're letting on, which ultimately was the problem.
Follow up to that.
Yeah.
Would the cash conversion cycle in that case be something you looked at?
Well, so in that case, that's actually going to help your cash conversion cycle, right? Because you're not paying your payables. So that's going to be great, but it's not. But it's ultimately not sustainable. Are you setting up a hedge fund?
No, but I'd like to join yours.
Okay. Anyone else? I'm here for lunch.
Any other job applicants? Right.
Yeah. Thank you.
Andre, sorry, maybe just one last question, and myth or fact, and we hear this very often in the market, and I think it's very much due to a lack of experience, but we are getting there. We are working on the educational hedge funds, specifically retail hedge funds in South Africa. Some investors still have this thought that because you can short sell, you can lose all my money.
So you're right that not right, but risk management on the short side is a lot more important than risk management on the long side. If you're wrong on a long, it becomes a smaller part of your portfolio. If you're wrong on a short, it actually becomes a bigger part of your portfolio. The most successful short sellers in the world have a large, diversified book of short sells. So typically, we short between 25 and 30 or 32 stock-specific names in South Africa, and even more in our emerging market fund, hedge fund. And so our shorts are typically sized 1/3 the size of a long. So that's, that provides plenty of leeway in case that happens. And we do a significant amount of risk management, right? We look at when you short a stock, you have to borrow it somewhere. So you look at what rate are you paying for that? From how many people are you borrowing? How much more borrow availability is there? What's the stock's liquidity? So we can tolerate some illiquidity on the long side of the portfolio, but not on the short side. On the short side, we'll only short companies if we think it's an absolute fraud. This accelerate property, which we call decelerate property around the office. That's an example of a smaller company where we just thought, gosh, I hope nobody works there. We just thought it was so dodgy that, we'll put it on.
Yeah, we're recording, so you can't mention it. Well, exactly. Andre, from my side, again, thank you so much for being here this afternoon. It's been a great privilege. Thank you very much.
Thank you.
Right, that brings us to a close, and I want to thank the rest of our presenters today as well. You've made for some really great content, a lot of food for thought out there, some controversial statements we made about various asset classes. So where the hell does it leave you? Right, we can engage further with some of these managers if you want to, so get hold of BCI team if you want to get in contact with any of the managers. I think some of the views were very clear, especially on SA equity. SA bonds specifically, and there's still some some way to go on some of the global equity markets, while some remain frothy. So I think, again, especially in frothy markets, active management, you need active management on your side. And we've also illustrated a couple of good multi-asset funds. If you don't want to make that call on how much global, local, bonds, cash, equity, give it to one of the multi-asset fund managers and they can make the decisions on your behalf and your client. To you, our audience, always grateful to see so many people here. It's fantastic to have you all here. And again, thank you for your continued support. From Olga and Tanya, Robert, Walton, Jade, everybody that's here, thank you so much. Please join us for lunch outside. I think Olga wants to say something.
Yeah.
Is it you, Olga?
I just want to say the
blinded by
last
lights.
words. Ladies always want to say something last. So just before we break for tea, I just want to thank you everybody for coming today, and I want you to give yourself a hand of applause, because Cape Town has truly set the bar as the best attended stop on our roadshow. So thank you all for coming. And then I would also like you to give another round of applause to Eugene, our MC.
Welcome.
Everybody knows him from our weekly sessions, and someone also once said it's so good to see a TV presenter in person, so thank you. Eugene has been the voice and the guide throughout our roadshow, and we would really like to thank him.
You're very welcome. Thank you.
So yeah, also just as Eugene said, thank you to all the speakers, the AV team at the back, to all the organizers for setting this up. I know it's been long hours, so thank you very much. The presentations will be shared after, and we've also got an insights pack that will be shared later or next week. So yeah. Thank you once again, Cape Town. Till next time, enjoy lunch.
Thanks, Olga.